Hello everybody and welcome to Analyzing Finance with Nick. This video is going to be a complete consolidation of my Iceberg of Economics series. Like I did recently with the Iceberg of Finance, I'm going to put together the multiple part series that I did on the Iceberg of Economics, consolidate them into one video, clean up a lot of the dead noise and dead space, and improve the sound quality and put it all in one single video so you can binge the whole thing at once. People seem to have a good reception of when I did this with the Iceberg of Finance. And this video, I'm going to do the same thing with the Iceberg of Economics. Like any iceberg meme, it starts a little bit dry at the surface, and the deeper it gets, the crazier it gets. Have fun out there navigating the Iceberg of Economics. And please leave your thoughts in the comments, or if there's any other things that I should add to create a potential even deeper layer of the iceberg. Thanks for watching, and thanks for all the support for this channel over the years. Welcome to Analyzing Finance with Nick. I'm going to bring back the Iceberg series. However, instead of the Iceberg of Finance, we are going to be doing the Iceberg of Economics. And the other difference is that instead of me writing the iceberg myself like I did with the Iceberg of Finance, in this series I found an iceberg on Reddit that somebody else made about the Iceberg of Economics, and it does a pretty good job of covering like the different types of schools of economics and other economic concepts that are broad enough that I can elaborate on to add some interesting insight, but specific enough to have different topics. And I'm going to use this guy as a template, or gal, whoever made it, because Reddit is semi-anonymous. And we'll start with that. And like any other iceberg, at the top, it's the very surface level, easy stuff that most people understand. And then as you go down, it goes into the more complex and crazy ideas within the field. And just after scanning it, I have an opinion on almost every one of these. So let's get started. And the first concept on the surface level is Keynesianism. Keynesianism is the economic model proposed by John Maynard Keynes, who was a famous and noteworthy British economist in the early 20th century. Keynesianism is the idea that the government should get involved to intervene in macroeconomics, and Keynes was one of the first truly macro economists, whereas most economists in the past were either microeconomists or studied what they termed political economy, which is just like how a specific policy would just affect a specific part of the economy, whereas Keynes really coined the ideas of aggregate supply and demand. He also had proposals to believe that even in a more capitalist society, the government had a role to intervene to manage business cycles using fiscal policy. I personally am not a fan of Keynesianism in this sense, because I think it is flawed to base on the morality of politicians to do the right thing. But it has nevertheless been a very influential school of economics that really dominated the mindset of policymakers from the dawn of the Great Depression until inflation in the 1970s kind of started to discredit and Keynesianism and expose some of the flaws that Keynesianism had. So now, what is Keynesian and fiscal policy then? It's the idea that when the economy is struggling and private demand contracts, that the government should pass stimulus policies, whether that's lowering taxes or increasing government spending on public works or social welfare or other projects, or a combination of the two, to stimulate economic growth and prevent a deflationary depression. And so when times are bad, the government loosens the purse strings to help put a support in an economy that lacks aggregate demand. However, the flip side that a lot of policymakers conveniently tend to ignore, and this is the main flaw of Keynesianism, I don't think there's really anything of Keynes' idea about using aggregate demand to smooth out business cycles is a horrible idea, but the problem is it cannot be executed because when times are good, you're supposed to, under a Keynesian model, pass fiscal austerity, which is either cutting government spending, which would be my preferred way of doing it in an ideal world, or by increasing taxes, or a combination of both to rebuild and rebalance the government's budget and build a reserve that you could use a stimulus for the next downturn. The problem is most politicians have no problem passing the stimulus when things go down because it gives them a chance to put in all the grab bag pork that they want into a bill and call it economic stimulus. But then when it comes time to tighten the purse during good economic times, it's crickets. None of them ever decide to enact that side of Keynesian policy. So Keynesian policy just effectively becomes an excuse for politicians to rack up bigger deficit spending. And then post 2008, there was the idea of Neo-Keynesianism that came around, which is the idea that the financial crisis caused such a big hit on people's balance sheets that the government has to go back to being aggressive and not using macroprudential regulations to prevent inflation, and that there's so much extra slack in the world that you could have a lot bigger of a budget than you would otherwise, and you need to be more aggressive stimulus than you would otherwise, and that deficits don't really matter, which is like the only really new thing compared to old Keynesianism. And that sounded great for a while, but then when that was tried during the pandemic, you got inflation quickly after, and that's the flaw of Keynesianism. This was exposed in the 70s when you had a Keynesian-style spending policies such as Lyndon Johnson's Great Society and similar measures in other countries, as well as the U.S. entry into the Vietnam War, and it created inflation because when it was time to tighten during the good times, the government's never had the political will to do so. The next one is, I already mentioned this, is aggregate supply and demand, and it's basically the idea that there's supply and demand is the basic curve that you show the line, the upward sloping supply curve and the downward sloping demand curve, and where they intersect is the market price. And you could use this for a variety of different commodities or services or even the labor market to explain how the change in supply affects the price if demand is constant or vice versa. Started with macroeconomists such as Keynes is the idea of aggregate supply and demand, that there's a total amount of goods and services supplied in the economy and total amount of demand based on the purchasing power of consumers and the willingness of governments and businesses to spend and invest. And you can build policy models based on influencing not just demand for an individual product or service or affecting the supply for a specific industry, product, or service, but you can do it for the entire economy in the form of aggregate supply and aggregate demand. It's pretty simple. The next one is GDP. GDP stands for gross domestic product. That's just the amount of economic output adjusted for inflation in the case of real GDP, not adjusted for inflation for nominal GDP, that is produced in a country in terms of goods and services in a given year. The net amount of money spent is the GDP. So, and the way that a lot of economies are measured for success is the GDP, or particularly the real GDP growth rate. So, and also the absolute level. And then it's just terms of like how much political power and influence. Like people think China is a threat simply because it has the second largest GDP in the world, based at least on their government's calculations. However, to really measure the true prosperity of a country, the better metric is GDP per capita, which is the amount of economic output produced divided by the number of people in the country's population. And as you would expect, the most successful developed countries are the ones with the highest GDP per capita, and some of the poorest countries in the world have the lowest GDP per capita. And the thing is, using not GDP on an absolute basis is misleading because like a poor poorer countries such as India, which has a fairly low standard of living, yet ranks in the top 10 in global GDP simply because it has over 1.3 billion people. And so it adjusts for country size, which I think needs to be factored in when it comes to these type of things. The next one I'm going to talk about is econometrics. Econometrics is the idea of trying to use mathematical and empirical testing to verify economic theories to see if they actually work in real life. As somebody who has an economics major in university and have several friends with master's or above degrees in economics, the one thing in the field that frustrates a lot of people is it a social science or is it a hard science? A lot of economists would like to have it be more of a hard science and treated such a way because it boosts their credibility. Because a flaw in a lot of economics, particularly in macroeconomics, which I did a video about this, which I'll link in the description, is the idea that macroeconomics is really just the mathematical and eloquently written explanation for why a politician wants to pursue a certain policy, and depending on how the government feels about its economic policy, they will promote economists or have them serve as advisors on presidential campaigns or work at think tanks that back the economic policy that the politicians or the administration in power wants them to. So in order to try to distance their theories and ideas away from being the rubber stamp of any particular policy agenda, whether it comes from the left or the right, you try to become more scientific to separate it from the world of sociology, and that is econometrics. And the problem is that you can do microeconomic experiments like in a double-blind controlled way on a university campus, but for more macroeconomics, it's difficult to do clinical trials in the same way you do in other sciences. So instead, you just look up data in different countries or regions and try to use one of them as the control and the other one as the experimental, and to see like what the true effect is of a certain economic policy or a certain economic trend impacts it. And it involves a lot of statistics and linear regressions and correlation analysis to sort this out and to figure out what's actually significant and what is actually noise. The flaw in econometrics is that it may show spurious correlations. The typical correlation is not causation, is generally a common refute of econometrics. But despite really, and also the fact there's just not enough observations or sample size, given just there's not that many macroeconomic samples for every sort of hypothetical scenario you want to test. However, with the advent of big data and easier ways to just compute that data, just with technology advancing and just the internet keeping track of more and more transactions, I think the efficacy of econometrics is going to continue to improve over time. And I actually generally tend to be a fan of economists trying to quantify, because if we could get real results, not spurious correlations, but if we can use statistical analysis of diverging economic policies to generate better outcomes, it means a rising living standard for everyone. So that's my thoughts on econometrics. Next, I'm going to talk about the Phillips Curve. The Phillips Curve is an economic theory that has generally been proven not to work, but it keeps getting resurrected after every business cycle. It's the idea that there's a stable and inverse relationship between inflation and unemployment. And so therefore, when the job market is hot and unemployment is low, that will trigger inflation, because a higher level of aggregate employment creates higher aggregate demand and supply doesn't rise fast enough. And that's what causes inflation. Whereas you have on the other side, when economic times are tough and there's less people employed, that reduces demand because people are out of the job and therefore they can't afford to buy stuff. And also it depresses wages because it's hard to negotiate a higher wage when you can have plenty of qualified unemployed people who can, or underemployed people who can replace you. The flaw really, again, is similar with the flaw of Keynesianism, was stagflation in the 70s, when you had both high unemployment and high inflation at the same time, which to me kind of discredited the Phillips curve. And we've even currently now, you've seen times of disinflation and inflation trending down, but the unemployment rate going down with it. This happened in the late 2010s, for example. And so that is the flaw of it. In theory, it makes sense, especially on the downside. However, there are other things that drive inflation, such as money supply and regulatory environment that restrict increasing supply, like such as what's going on with the housing supply in many developed countries in the world right now, which I think are far more powerful than the employment variable when it comes to inflation. So that's why I generally discount the Phillips curve. Next is Neoclassical Economics and the Neoclassical Synthesis. Classical economics is the idea, especially in macroeconomics, is that the rules of microeconomics apply to macroeconomics, and that most businesses, individuals, and governments are entirely rational and will make the decision that makes sense to maximize their utility. And Keynesianism brought, and this is one of the more, I think, accurate and positive contributions that Keynes had, was that he brought in the idea of animal spirits, really, in a way. It's the idea that, especially in investments, but in other assets too, and goods and services, like the economy can be irrational. Keynes is actually famous for his comment on short selling, that the market can stay irrational longer than you can stay solvent, which is a very astute quote. And it's the idea that that is what the problem with classical economics is, just assume that everybody always acts rationally all the time. And also, the other thing that Keynesians challenged the classical economists on was the idea that bigger aggregates, supply and demand, and also governments don't apply to the same rules that individuals and small businesses do, in the sense that they have to balance a budget and they have certain limitations in terms of spending and borrowing. So that is the other dynamic that the Keynesians challenged. Well, the synthesis is the idea when Keynesianism was, as credibility started to come on the rocks with the stagflation in the 70s, that you could take parts of both the classical model and the Keynesian model to create a neoclassical view of economics that was more accurate than both of the previous two worldviews. Examples of provisions in this is that people are generally rational enough that microeconomics in the classical sense remains applicable, and businesses are rational enough so that aggregate supply generally follows a rational utility maximizing framework. And animal spirits, however, still do matter, and especially in the capital markets. And it has to be applied to certain parts of the economy that are more prone to animal spirits. The idea also of sticky wages, the idea that even if you have the price level drop, it doesn't mean that people are going to accept a wage cut. If the price level drops 5%, people will still not accept a 2% wage cut. It's the idea that wages are sticky. They only ratchet one way, which is higher, and the way to lower real wages is via inflation, where inflation is higher than your wage growth, and that's how you adjust for that imbalance. And also, it's the idea, they employ some of the ideas of monetarism, which we're going to get into later. And so that's what neoclassical economics was. And that's kind of the economics that I was primarily taught in my undergraduate education before the financial crisis. The next concept we're going to talk about is, in this chapter, is capitalism. Capitalism, really to keep things simple, is the idea that we have a economy with a free market and that resources are distributed based on who supplies what the most people demand or what is most valued in the economy. Capitalism is amoral in the sense that the market doesn't have to supply what is the morally right outcome. Like, for example, look at a lot of the morally distasteful industries in the world that are yet very wealthy and very successful because there are people who demand it, whether we believe that it is right or wrong. I'm not going to get into specifics because this isn't analyzing philosophy with Nick, but you get my idea. And capitalism historically is the way to maximize wealth on the aggregate. The main flaw that people have with capitalism is that it generally leads to very unequal and usually outright Pareto-based distributions, where those who are on the losing end of the Pareto curve tend to think is unfair. But yeah, capitalism is basically a free market. It's what people believe like America is, whereas America really is a mixed economy that has some capitalist side and some government regulated side, which is more socialistic in nature. But yeah, capitalism is basically the idea of having a free market decide the allocation of goods and services and the distribution of wealth in society. And then the last thing we are going to talk about here is CPI. And CPI is just the consumer price index, which is the measure of inflation that the government uses. And CPI-U is really just CPI for urban consumers. And in most developed countries where the urban population is over 85% of the total population, that's what people use as a metric. And what they do is they take a basket of goods and services and see how the change in those prices are over time, and that is your cumulative inflation over that period of time. This is usually measured year over year. So if the basket is $100 at the end of 2022, and at the end of this year it's now 105, then the CPI inflation rate is 5%. And there's two types of CPI. There's headline CPI, which includes food and energy, which are more volatile than the other parts of the inflation metrics. And they are combined about 15% of the basket. And then you have core CPI, which excludes food and energy due to the intense volatility of commodity prices, which skew inflation. I think CPI, the way it's calculated, has a lot of flaws. First, it underestimates the degree of inflation in the housing market because it uses a flawed metric called owner's equivalent rent, where the surveyors will call people and ask, like, homeowners, if you were to rent out your house, what would you rent it for? And if you're an owner-occupier, you don't really think about that. And so that data can be stale, and it's also heavily lagging compared to looking at tracking asking rents or agreed upon rents or housing transactions, which are probably more accurate real time. And due to this lag, it overestimates inflation when housing markets fall and rents fall and we have a recessionary environment. It underestimates inflation most of the time when the economy is good and housing prices and rents are rising. And housing is 41% of core CPI. So it really messes with it, and their cumulatively inflation has probably been much higher simply because of this calculation error. And they also just, these blind surveys relatively in analog ways in a world where you get digital prices tends to just be flawed for a lot of the other components where you should use more accurate private sector data. This is actually a service that I provide for my research clients where I create my own alternative headline and core CPIs based on using more private sector data and comparing it to the government's amounts. And I think that the reason I go on my way to do this is because of some of the calculational flaws in the CPI. The idea of measuring inflation is important. There's a lot of conspiracies that the CPI is even way higher than even my estimates are, and that they're just systematically getting poorer as a way to prevent COLA payments for Social Security and government payrolls from increasing too high for the government to manage. But I talked about like the truth of inflation in a different video where I elaborate more on a lot of this. But That's the bottom line of CPI. It's just the way you measure inflation. It's a flawed metric. I think the weights that they use are fairly accurate. I just don't trust how they get the inputs. The iceberg meme that I found on Reddit about this has 8 tiers, but one of them is one term, level 8, which I'm not even sure what that concept is. So I'm going to be replacing that with a tier of obscure heterodox economic philosophies, and then I'm going to have an even lower tier, which is what I call Crazy Town, which are going to be my theories on the subject of economics as an economist myself, that's apart from mainstream economics, Keynesianism, and or Austrian economics. And then that will conclude the series. The first one on the surface level is the IS-LM model, which is basically a Keynesian macroeconomic model which describes the relationship between the demand for financial assets versus economic goods and services. And basically, when the cost of money is cheaper, aka lower interest rates, that increases demand for goods and services for a number of reasons. One, asset prices go up and that creates a sense of wealth effect. But two, borrowing becomes more affordable. So those who have the propensity to live beyond their means can now do so due to cheaper financing. And then the reverse happens when money tightens. I know it does sound very monetaristic, but it's technically a Keynesian model, but it basically shows on a graph really that the intersection really between the loanable funds and the money market and aggregate demand have some sort of correlation. And it's also known as the Hicks model because it was created by the British economist John Hicks in 1937. The next one we are going to be talking about are corporations. Now, corporations are often a boogeyman for the economically illiterate, but a corporation really simply is a legal entity that represents the operations of a business, or in the case of a 501, a nonprofit. There are many reasons to start corporations, but the main one is for limited liability. Whereas if you are sole proprietorship without some sort of corporate veil, then if your business attains too much financial distress and fails because of it, you are personally on the hook. And there are many countries in Europe and in East Asia where even though there technically are corporations, small business owners still are on the hook in the event their businesses fail. And that's why their entrepreneurship rates are considerably lower in those countries than in the US, which is more forgiving bankruptcy laws. There are a variety of corporations. The most common one among publicly traded companies is a C corporation, which a C corporation has double taxation as the downside, where you have to pay a corporate income tax and then the shareholders pay on the distributions their individual income tax. The reason why you'd want a C Corp is because C Corps allow a much larger base of shareholders than an S Corp or an LLC would. And they also make things a lot easier if you want to go public. Like public offerings are not done with other types of corporations. So C Corps are help with exit liquidity and selling to other minority interests, or also make the process going public to be easier. But at the expense of shareholder liquidity, the downside of a C Corp is you have double taxation. The other two main corporations are, at least for for-profit companies, are S Corps and LLCs. And these are mainly done by self-employed or small business owners. The limit really to LLCs and S Corps is that they can't really have more than 100 shareholders. You have to switch to a C Corp, and that's again what I mentioned, why you don't see S Corp or LLCs going public. The next one we're going to be talking about is green growth. Green growth, and you'll see this with a lot of these things in the iceberg, is really just this idea of trying to insert current political and social goals into economics to create an economic philosophy that will justify pursuing normally non-economic actions to make it seem like they actually are economic actions. And it's not just environmentalists. I'm not picking on them. It's just that environmentalism is the trendier school of thought that is being inserted in economics because of concerns of climate change. But this could apply to a lot of other goals. Like if you have a social goal and you want to make it sound like it's a good idea for the economy, you will make some economic theory revolving around how there are so much negative externalities, which there actually are negative externalities for the environment. It's just really the question is, what is the degree of negative externalities of industry to the environment? Is really the debate that goes on there. But it's just the point is that when you have a social goal, you try to goal seek it into a theory of economics to make it seem like achieving the social goal is actually an economically optimal path when it may not be. So that is green growth is just one of these. It's just the idea that economic growth, as long as economic growth remains a predominant goal, that the environmental impacts of that economic growth are not being properly accounted for. And as a result, economists and policymakers need to change the goal away from just maximizing economic growth to having the maximum economic growth that can be done in a way that is sustainable for the environment. The next one we're going to be talking about is the Big Mac Index. The Big Mac Index, which is most popularly tracked by The Economist magazine, is this idea that you could compare the relative price levels of different countries based on the cost of a Big Mac. Because McDonald's is in most countries in the world, and with that, you can compare the price of a Big Mac is, say, in the US versus South Africa versus Brazil versus Mexico versus France or Japan or China. Have a good idea of either one, whether a currency is over or undervalued compared to purchasing power parity, or two, what is the general purchasing power parity? So as of currently, the most expensive overpriced Big Mac right now is a Swiss franc denominated Big Mac. So in Switzerland, it costs about $6 and not $6, 6.7 francs for a Big Mac, whereas it's $5.58 in the U.S. That's implying an exchange rate of 1.2 francs for every U.S. dollar, whereas in reality, the actual exchange rate is 87 cents for a Swiss franc. And as a result, Big Macs are 38.5% overvalued relative to the US, which means implying that the Swiss franc is overvalued relative to the dollar. If you look at right now, there's only 7 countries that have a Big Mac that costs more than it does in the United States right now. That includes Switzerland, Norway, Uruguay, surprisingly, actually, Argentina, the Eurozone, Sweden, and Denmark. So, yeah, and pretty much, and even that's the case, even with a euro that is trading below what my expectations are for purchasing power parity. So, it means that Big Macs are relatively more expensive in Europe and the Southern Cone than elsewhere. Whereas the cheapest one would be in Taiwan, where a Big Mac in Taiwan just costs 75 new Taiwan dollars and versus $5.58 USD. But given that the exchange rate is 31 new Taiwan dollars to the US dollar, that's paying less than $3 for a Big Mac, and therefore in Taiwan, Big Macs are 57% relatively undervalued. The flaw of this is that Big Macs are not representative of the general economy, especially as a lot of people are moving away from eating McDonald's in developed countries for health reasons, and also how things such as housing and services are bigger drivers for the economy than the cost of food. And as a country gets more prosperous, food as a percentage of a budget goes down. And in countries where food is a higher percentage of a budget, McDonald's doesn't have the same pricing power for its Big Mac. So emerging market economies structurally are going to always have cheaper Big Macs, because not necessarily because it's always that much cheaper to produce a hamburger there. Well, labor costs do that, but the fact that just the consumer purchasing power in those countries just kind of forces its hand on that way. And if you look at the history of this, the dollar is quite a bit stronger than it has been historically. And that's been really the case for the last several years. And there's a lot of macro reasons, which I've talked about in previous videos and I could elaborate in the future. But that's a wrap really for the Big Mac Index. The next concept is fractional reserve banking. I have strong opinions on this one, but I'm going to try to explain this as objectively as possible. Fractional reserve banking is the idea that when you deposit your money in the bank doesn't always have $1 for every dollar you have in deposits available. That would be called full reserve banking, where everything you put in the bank has equal amount of money backing it, so that you can't really have a bank run. Whereas fractional reserve banking is that this is what it is, basically what its name says. Only a fraction of the money, the total deposits, is sitting in the bank as deposits. The remainder is being lent out. And this is what creates the money multiplier effect. Money supply grows when you have more money that lent out, and that money gets put in the bank, and a fraction of that gets lent out, and that cycle keeps repeating. And you could really kind of calculate the money multiplier effect by having 1 divided the required reserve rate, and that will generally give you your money multiplier rate. In the US, the reserve requirement rate is historically been and still is 10%. So that means that the banks have to keep about 10% of their capital in the bank at all times. SIFI institutions have higher capital requirements due to them being deemed a systematic risk during the Great Financial Crisis. Some other countries have lower reserve requirements, but I'm just going to use 10% as an easy example. So if you have 10% reserve requirement, then you can lend out the other 90% of your money, and it effectively creates a 10 times money multiplier. So for every dollar deposited in the bank, you have creating another $9 in loans. And then if you put $100 in the bank keeps $10. Then the bank lends out the other 90. The person who takes that loan puts that money in the bank. Then the bank lends out 81 of that dollars, and they keep 9 as the reserve requirement. And this keeps going until it approximately increases the money supply by about 10 times when this is all said and done. And that's why when you have increased levels of lending, money supply increases. And when you have credit crunches and people default on their debts, then you see the money supply contract. The main downside of fractional reserve banking is bank runs. If you have more than 10% of your customers all wanting your money at the same time, then the bank may not have all of the money, and then the bank fails. This is what happened in the Great Depression, and this is what happened recently with Silicon Valley Bank back in March. And this creates volatility in the economy, because if your money's in the bank and you happen to not get it out during the run, then you're out of luck and you have no money. I mean, at least in the era before deposit insurance. This is why deposit insurance was passed during the Great Depression, was to try to stem off bank runs. And in the event a bank did fail, smaller depositors who were not aware of the risks of the bank do not get punished. The merits of deposit insurance are something I could talk about in a different video. But the bottom line really is that the main risk really for fractional reserve banking is that it creates business cycles, because you can create all this money. For all the money you create, it has to be paid back in its entirety, plus an interest rate. But the the banking system is not creating all that money plus the interest rate. And that's what causes credit crunches, because when it's time to pay back some of these long-dated projects, a lot of the borrowers just simply did not generate enough value to pay those back. And in theory, you should have enough economic growth to cover it, but interest rates are generally higher than economic growth, and that is especially towards the end of cycles to keep inflation in check when central banks raise rates. And that is what partially causes a business cycle. Again, this is a very oversimplified version of business cycle analysis, so don't grill me too much on the details of that in the comments. The next thing we're going to talk about is the efficient market hypothesis, or EMH. If I believed in efficient market hypothesis, I would not be working in this profession or making these videos. So that probably tells you my stance on efficient market hypothesis. But it's the idea that all the known information in the world is priced in to every security, stocks or bonds or commodities, and outside of insider trading, there is no way to generate any alpha, because all the information, whether it's fundamental analysis, technical analysis, etc., the crowd as a whole combined knows enough so that whatever the current price is, at the current moment with the current facts and the current information, that is the accurate price level. And if that's the case, then there's no room for excess returns for the market pricing a stock or any other security inaccurately. The arguments in favor of the efficient market hypothesis is that most large cap mutual fund managers, about 85% of them, fail to beat a market index over the long run, and that it's very difficult for alpha to be quantified by academic research. But I think also there's a lot of flaws to this theory. First, the way that academics are doing the research for what works and what doesn't work in the market is much longer dated and much slower than market participants react. When there's a source of edge in the market, it may last only for a few weeks, a few months, or a few years, whereas academic studies try to test the impact of a market anomaly over much longer periods of time when the edge has long been filtered out from that specific anomaly. And a lot of the inconsistencies in the market also are not really easy to quantify, or not well known by academics, or by the time they are, that edge is gone. And then the other side of it is a lot of what's going on in the market too is psychological. And it's hard to really try and experiment who has better nerves to trade in and out of the markets and navigate the emotions of fear and greed that dominate business cycles. Like, if there was truly an efficient market, you would have never had the tech bubble and the tech bust in the 2000s. You wouldn't have seen a lot of stocks in the non-banking sector get destroyed like they did during the GFC. And you wouldn't see a lot of these other mini bubbles or busts. And my most controversial take, if there was truly an efficient market, Bitcoin and a lot of these cryptocurrencies would not have the same kind of value. And let's just say, for argument's sake, that Bitcoin is digital gold and has a legitimate intrinsic value. In that case, the altcoins should all, if it was a truly efficient market, all the altcoins would be worth zero, and only Bitcoin would have value. Or if you are somebody who just doesn't believe any of these cryptocurrencies have intrinsic value, let's just put that argument aside, then the fact that these cryptocurrencies exist and are trading at a price above zero is kind of a debunking of the efficient market hypothesis. Either way, whatever stance you have on crypto, let's just say crypto is an exception because it's a really weird and not as liquid or popularly traded market. Well, then again, why do we have manic motions in the market, bulls and bear markets? Like, for example, excluding, like, you have stock going down 20% on no news, no earnings report in a calendar year, and fundamentals haven't changed. Is that because the fundamentals have changed and the market doesn't know. If that's the case, then value investors would be all out of business. Warren Buffett probably wouldn't exist. Seth Klarman probably wouldn't exist. A lot of others wouldn't exist either. Steve Romick. The thing is, though, the counter argument to that would be, well, if you just have a 64 team bracket, or a lot bigger, I guess, 64,000 hedge fund and mutual fund bracket, the Warren Buffetts and the Romicks of the world really are just survivorship bias. That's what happens if you flip a coin enough times over a certain amount of years with all the market participants. Of course, you're going to have a few left who've gotten lucky. But just my practical experience as a practitioner in the financial markets, it's very self-evident to me that the efficient market hypothesis is incorrect, mainly because of the emotional behaviors of many non-economic actors and the history of markets and business cycles, and a lot of just general mispricings that are seen. I mean, is it easy? No, it's not easy. That's why not everybody's just sitting on a beach sipping Mai Tais while watching their stocks go up. But it can be done. And then the last one for this iceberg is the social market economy. A social market economy, or also known as democratic socialism, is the idea that you can integrate some parts of capitalism and socialism to create a more optimized society for those living in it. The most famous examples of these would be the countries in Scandinavia, where you have a fairly low regulation business climate, and the state doesn't really get involved in operating decisions like in traditional socialism would be implied. But it's not entirely a free economy in the sense that you have very high tax rates, which effectively makes the government a silent business partner in every operation in your country. And that money is redistributed to achieve social goals, whether it's subsidizing healthcare, education, keeping the poor off the streets, or whatever the government, the voters see to be fit. This is also kind of known as a mixed economy, but a social market economy leans more on having a large welfare state and the government covering a lot of the basic costs of living for people, but in exchange is that people have effective ceilings and limitations on their incomes due to very high tax rates. The upside of this is that it provides a lot of social stability. The lower classes particularly like the social stability for it. People who have more modest ambitions and means can feel more comfortable and have less sense of jealousy, because it's very hard for somebody who wants to actually get ahead to do so, just because of the costs of financing this government and the high taxes involved. If you're paying 60, 70 cents on the dollar to the government, then it's very difficult to build any meaningful savings and investments, and to have a standard of living that is meaningfully higher than somebody in a lower tax bracket, because the gap between your guys' take-home pay is far lower than it would be if it was a less high tax environment. And so, yeah, you're basically trading off social stability for economic growth and opportunities to make it big. The example of see is the comparison of Western Europe compared to the United States. Even though both have capitalist and socialist components to them, I would say that the European dream is more of the social market economy, and the United States is the closest, I would say, or one of the closest to a free market economy, even though there are social protections in the US. Syndicalism is a radical, semi-anarchist, semi-socialist. It's kind of a mix of both, where that the government and most businesses and institutions are all controlled by unions. If you wanted to say this in jest, you can argue that the education system in the state of California is syndicalist. By that, the teachers union has a lot of power in deciding how things go there. But really, on a more serious note, it's the idea that you would basically have a general strike where union leaders across all major industries would coordinate and all shut down together to effectively seize control of the government by saying, we're not going to go back to work and we're not going to produce anything unless if the government steps down and allows union leaders and just the unions in general to make decisions on production and rule of law and everything like that. This is very chaotic in nature, an ideology like this, and it did have some traction, particularly in France, the Iberian Peninsula, and Latin America. However, by the end of World War II, syndicalism died out effectively across the world. And the main reason for the death of syndicalism was either A, authoritarians on the left side of the aisle basically co-opted syndicalism into becoming more authoritarian style communism, as you've seen in the Eastern Bloc and China in the post-World War II world. Where in the West, you saw living standards go up even for the working classes to such a relatively high level that the working classes can now afford to be consumers in the capitalist economy and now have and investors in the financial markets and homeowners and have more of a skin in the game and a stake in the society. And as a result, syndicalism lost its popularity because a lot of the same workers who would be the source to threaten a shutdown of society now have a reason not to want to shut down society and have unions control everything because they have a stake in it and they benefit from the free market economy. I think syndicalism or neo-syndicalist ideas could pop up in the event that you see too much redistribution up the wealth curve and you see a lot of younger generations never buy property or never having meaningful balance in their 401k, and they start to get more sympathetic to this and other more radical left-wing ideas. But for now, syndicalism is in the dustbins of history. The next thing we're going to talk about in the iceberg of economics is central planning. And central planning is really the idea that you could use a combination of government hired bureaucrats and academics and policymakers can decide how the economy should play out. And with this planning, they can create better outcomes than if it was done entirely with the free market. The most common example of this is the Soviet Union and a lot of the communist countries in the 20th century, where you had bureaucrats literally deciding how much bread there was on the shelf and what the salary for every profession in the economy was. And that resulted into a bunch of inefficiencies, which was really the main problem for central planning to that degree. But central planning doesn't have to be just for the whole economy in a totalitarian sense. You could argue that the Federal Reserve is effectively central planning the economy by determining the price of money impacts what loans are viable and what loans are not viable, and therefore what projects can receive capital and what not, and also affects asset prices. Like the price of housing is very contingent on interest rates. The price of the stock market is heavily contingent on interest rates. And the Federal Market Committee is 12 governors who basically decide what the cost of money should be. That is central planning. It's just not the entire economy, but it effectively is for the financial system. And there are several other regulatory bodies that have similar powers, even in so-called free market economies, to put a lot of central planning into how their sub-industries work. A good example of this was the interview I did with Austin Walters discussing the degree of central planning within the healthcare industry, which has led to a lot of the inefficiencies within the healthcare industry. The next topic we're going to be talking about, central planning, I already hinted at this, is communism. Communism is the idea that you have no private property, effectively. Communism is, and the idea is that proto-communist idea has been around really since Jean-Jacques Rousseau, and the emotions that drive communism have been around since the dawn of time, mainly envy. But it really got formalized as a defined ideology through Karl Marx's The Communist Manifesto and Das Kapital. And it had a lot of appeal to people because in a world that got more secular, communism was promising this idea of heaven on earth where there wouldn't be greedy capitalist business owners and wealthy elites who own everything. There would be everybody would have everything except there wouldn't be any ownership. Everybody would just share everything out of the goodness of their hearts, and everybody would be prosperous, and everything would be fair, and everybody would be equal. In practice, it didn't really work that way. In mostly authoritarian communist regimes, what happened ultimately was that the political elites still remained on top. They were just a new type of political elites with a new political ideology. But since you didn't really have market forces making the economy efficient or really drive any incentive to drive growth, everybody else became poor. And that was really the flaw of communism. And also there's the calculation problem, which I mentioned in the central planning tidbit, is that it's hard for bureaucrats to basically accurately determine how much bread there should be in every single grocery store in every part of your country, or what should the salary be of every single profession, without creating shortages or gluts for overpaying one group of people relative to the other. And if you pay everybody the same amount of money, no matter what they do for a living, which is the goal of communism, it's for each gives to their ability and takes what they need. You have a lot of disincentives for more skilled people to produce, and you have more incentives for people to do jobs that or simply not participate. In the authoritarian communist countries, you had to work or you were basically just cut out of the system or jailed, depending on where we're talking about. Like in the ideal sense, and you didn't really have that type of punishment, which you wouldn't in what would be a true communist society according to the ideologues here. You would have a heavy disincentive for people just to shirk and not participate because there's no benefit. You get the same benefits as if you do participate, even if you don't. And that's also one of the flaws of communism. So yeah, this ideology was most popular in countries with very stratified social hierarchies where they accelerated quickly to the market economy before they switched to communism, and there's a lot of disruptions and there were a lot more losers than winners, and they used this collective force to win. But the thing is that if it wasn't really for the Russian Revolution succeeding, and to get into the causes of the Russian Revolution and why they were able to succeed when other similar revolutions failed in other parts of Europe and in the Americas at the time, it was a whole nother topic. That's more of a history topic. But I think that the implicit military and financial support from the Soviet Union once they did flip communist was really the big driver for a lot of these other countries turning. If they didn't have the backing of the Soviet Union, I don't think communism would have spread nearly as far as it did in the peak shortly after World War II. But yeah, that's my comments on communism. And socialism, according to the Communist Manifesto, and is the transition stage between communism, which would effectively be an anarchist state with no government, but everybody just voluntarily contributes their piece to the society and splits everything evenly and create their heaven on earth. But the step in between is socialism, where you have the government seize control of all of the businesses and all the means of production, and you have it's usually authoritarian, but in theory could be democratic, where the government will be the one who decides where to allocate all the resources of the economy. That in a social market economy, private business owners still own the businesses. There still is a private sector. Whereas in a truly socialist economy, there would not be a private sector. Everything would be effectively controlled by the state and owned by the state. And this would just be a transition that the state would do this until people got used to this new system, and then gradually the state would deteriorate and people would naturally just be adapted to a more communist mindset, and it's become self-sustaining. like by this definition of socialism, a lot of the communist bloc during the Cold War was effectively socialist. Democratic socialism is really social market economy. Democratic socialism, the idea of that, which was popularized by Bernie Sanders in his 2016 and 2020 elections, that you can democratically vote for a more socialist economy, which you have more welfare, higher taxation, more government regulation and control, and arguably even nationalizing some industries. Some countries in Europe actually did go this far and nationalized a lot of industries. India was also a country that went pretty far on the socialist side, where they outright owned a lot of parts of the private sector and different industries. And you have some countries where certain sectors are nationalized and socialized, such as the energy industry in Mexico. But then the rest started to heavily deregulate and exit out of these. The most aggressive for these moves was the US and the UK under Reagan and Thatcher, where they sold off a lot of state-owned industries to make their economies more efficient. But yeah, that's socialism. The main difference between socialism and social market economy is ownership, is direct ownership versus just high taxes. Next, we're going to discuss rent control. Rent control, by definition, is when a jurisdiction puts an effective cap on the amount a landlord can charge in rent to tenants. This can be done in a variety of ways. It can be a hard cap or a hard rent control where you just can't increase prices, period. You can have rent controls where you cannot increase prices by a fixed amount. You can have rent control where rents are not allowed to increase more than CPI or CPI plus a spread. Or you can have just a maximum of what you can raise it by that's fairly high, which diminishes the power of rent control. And you've seen different examples of these across all jurisdictions. The ones with the most onerous levels of rent control are New York, San Francisco, and Los Angeles in the United States. But recently they've passed rent controls in general across the state of California for apartments, where it is CPI plus 5% as the cap, which is fairly wide. But like in a time with extreme housing tightness, it could cause a lot of inoptimal outcomes, like what happened the last couple of years to a high shock in rent inflation, where you saw rents going up at one point almost 20% year over year. Rent control is probably one of the most flawed economic policies out there, and has one of the poorest empirical track records. And prior to when housing became a major political issue in the last decade, in terms of rent costs, particularly among millennials, it was pretty unanimous for economists to criticize rent controls and denounce them. But now you're starting to see economists on the left sympathize with it because, as I've mentioned before, with economics, it's not just left-wingers who do this. Right-wingers have done this too, with the idea if you could cut taxes and you could generate enough growth automatically that you don't need to cut spending to compensate it. Rent control, the days that people will create their economic policies and solutions and ideology based on a political goal they're trying to accomplish. So that's why rent control is no longer a consensus bad idea. But there's a reason why it was a consensus bad idea, is because it creates a lot of negative incentives in the real estate market. One, it depresses the values of properties in rent-controlled areas, because if you know that your tenants are stuck in rent control and you can't really evict them unless there's very extraordinary exceptions, such as if you want to own or occupy the place for an extended period of time, then the cash flows are not going to be high enough to justify what like the purchase price is. So people will have to pay a lower price to be compensated for that. But if that was the only problem, I wouldn't really be that strongly against rent control. The main problem is what it does to tenants. One, it discourages people from moving, and that, as a result, tightens the supply of remaining apartments in a city. So say, for example, you have rent control passed 20 years ago, and rent inflation is way higher than what the maximum amount increases under the rent control is. So anybody who got assigned a lease and wants to stay in that city has not moved, because if they move, they're going to have to pay market rate, which will be much higher, because the market rate does move with inflation, real inflation in housing, not the rent control level. The rent control only kicks in after, at least in the way it works in American cities. I think maybe there's other countries, maybe they have hard rent controls, but hard rent controls have their own sets of problems. Mainly that there'd be no incentive to develop property or to maintain property. And even in softer rent controls that are there, still is no incentive to maintain property, because if you're not getting compensated the fair value, you might as well let the apartment degrade and not cover maintenance beyond whatever's the government mandated minimums. Because if the person doesn't like it and doesn't want to stay, then if they move out, you actually benefit from that, because then you could raise the rates back to market rate. But the main problem is people don't move out, and therefore that shrinks the supply. And so the remaining people who are trying to move into a city therefore have to pay more, because there is a tightness in supply that there wouldn't be if there was a more liquid market for rentals. So basically, the people who benefit are the people who were there before the rent controls or live in their place for 5+ years. And anybody who either moves around a lot, either due to different jobs or graduating from college and moving to a new city, or your family gets bigger so you can't stay in the studio apartment anymore and have to get a bigger place, they are the losers of rent control. And on the aggregate, the losers of rent control are a lot larger in numbers than the few winners. Like, I remember when I lived in San Francisco, I hear this story about people would move into like a 3-bedroom apartment in North Beach, which is a fairly nice neighborhood in the city, at least back when I lived there. And they would pay $900 a month for this apartment. They got in, they moved in the 80s when it was maybe like that much. And now with the caps and rent controls, maybe the rent is maybe gone from $900 a month to $1,200 a month. Whereas if you didn't have rent control and you wanted to get that on the market, that same apartment would be $6,000 a month now. And that is just example, like just like an anecdote, but for a broader problem is that the rent control basically disincentivizes people to move and just artificially restricts a market that a lot of these cities passed rent controls because the markets were tight to begin with, and people were complaining about high cost of living. And so the politicians, oh, why don't we cap the rent to help solve this problem? But really it does. It just makes an already tight housing market worse. You have less incentive to develop the property because you can't raise rents with your costs or with market forces, and you have less incentive to maintain your property. So that's why you see a lot of older, dilapidated properties, especially on the inside in some of these rent-controlled cities. So overall, it's an idea that comes from the right place in the heart, but practically just doesn't work. Next one I'm going to talk about is full reserve banking. I already discussed this in the surface level where we talked about fractional reserve banking. It's the same thing, except every dollar in the bank is backed by a dollar in the bank. So there is no money multiplier effect. The main upside of this is that the banking system is a lot more stable, because you can't have a bank run if everybody's money is always in the bank. The downside is lending in this environment would be prohibitively expensive because the money supply would be a lot lower, and therefore, since banks have to be paid back on that, and there's really no like liquidity out there, it has to be, everything in the bank has to be fully backed, then in order for a bank to even consider taking such a risk of capital impairment on their loans, they would have to lend at very high interest rates, which you can argue could be a good thing if all these loans are just credit card debt or student loans and frivolous majors or other more wasteful parts of money. But a lot of businesses need loans to get started and grow. And basically, there'd be no mortgage market in that environment either, because the mortgage interest rates would be so high, nobody would be able to afford to borrow to buy a house. Would effectively have to pay for it in cash, which would either means housing prices would be a lot lower, and or people would just be lifelong renters, and there'd just be a landlord class that owns all the real estate. So you're basically trading off removing the business cycle for slower growth in a full reserve banking environment. I mean, fractional reserve banking didn't really come from legislation. It was just market forces that banks said, hey, we have all this money and not everybody's going to come and take it back at the same time. So they took a little risk and lent on it. In fact, actually, reserve requirements were a response to banks' perform reserve requirements having way too low of a fraction of their banks and their reserves and demand deposits available. And so that it's, if anything, if you're going to have a full reserve banking system, it wouldn't be like what libertarians say in a free market would be full reserve banking. No, full reserve banking would have to be heavily legislated and regulated by the government because the bankers would have incentives to deviate, even if it's just by a small amount, due to just the upside potential of having much more capital available to lend when nobody else is willing to lend due to sticking to their full reserve banking commitments. The next one I'm going to talk about is environmental economics, which is kind of the same idea as green growth. It seems like a lot of these on the iceberg is really just talking about economic theories to justify factoring in the negative externalities of the environment and climate change. And that's what environmental economics is. It talks about how the market fails to, on a climate and or environmental adjusted basis, to have a market optimal outcome. The markets are more likely to create negative externalities via pollution because money today is, especially when interest rates are low, when interest rates are high, you'd rather have the money today than the money tomorrow. You may not be alive really long enough to benefit, or I guess suffer in this case, from the negative externality. And then also I think environmental economics also deals with the tragedy of the commons, where you have a common property resource and since nobody owns it, there's no reason to protect it and operate in a sustainable way. An example would be like an open pasture that's not fenced off, and all the ranchers go have their cows feed on that pasture because they could keep their grass for themselves on the property they own. They'd rather have it in the their cows eat in the open pasture. The problem is every rancher is going to think this way, and therefore pretty soon that pasture is going to be completely barren and have no grass in it at all because nobody really managed to maintain the proper level of grass or to allow nature to do its thing and have it grow gradually and not to be overgrazed. The solution to that was, again, private property. If it's your property, you have incentive to take care of it better and make sure that you don't overgraze your property because otherwise your cows are going to have nothing to eat or you're going to have to import hay from another farm at a much more expensive cost. I mean, this wasn't tragedy of the commons, but I think I'm going to include that in parentheses here because we talked about effectively environmental economics when I was discussing green growth. And then the last one we're going to talk about in this section of the economics iceberg are worker cooperatives, which worker cooperatives are basically the organization that would run the world in a syndicalist system. A worker cooperative is the idea of a company that is self-managed and owned by its workers. And I mean, we have employee-owned businesses today. A lot of the companies like especially smaller businesses where the business owners and the founders are the only people who work there. You have profit sharing agreements and stock option compensation for a lot of technology and big publicly traded companies and startups where like you compensate the employees at startups less up front, but in exchange they get equity. So if the company grows, they will do better and take some of the winnings from that. But these are a little bit more differently. These are just basically the idea that you have every corporate decision be voted on by the workers like it's a government or a state election or something like that. Even the companies who give corporate stock options and stock to the compensation to their employees do not give enough that they have enough shares to really influence policy. Whereas in a worker cooperative, in the old school sense of it, it would literally just be divided evenly by all the workers. There wouldn't really be management, or if there was, it would be like a politician is now they're elected in elections for a fixed term, and they would do what in the best interest of the workers. But what I know about worker cooperatives historically, the idea was it was a more direct democracy style for companies. And they have had some success of sticking around longer than other companies, and because they're less likely to vote on, not because necessarily they're better, but they're less likely to vote on improving themselves being acquired. And usually in acquisitions, you have layoffs of redundant workers. So you can see why a worker cooperative would vote against its company being acquired, because some of the synergies would be those workers losing their jobs. And then you also probably have you have lower pay gaps in worker cooperatives than you do in traditional companies as well. Mainly because, again, since people are voting on pay and voting on every major decision, people aren't going to vote for management to have excessively higher pay than they are, because why would you do that? Like, you see how unpopular it is to raise salaries for congressmen in the United States. You can see how that works on a business level too. And so, yeah, the reason why, again, these don't really work that well is because they're not really, it's hard to make longer term strategic decisions. And this is also the flaws with public companies who have to report earnings every quarter, have similar pressure from their shareholders. If you have everything voted on election for the workers, and there's also an agency problem. Even if the workers are shareholders, the workers have different interests than what would be a for-profit shareholder would, and those conflict of interest really hold back worker cooperatives. It's probably why you don't see that many like major large worker cooperatives in the modern era. I mean, they do have some in Europe, and most notably in Italy and Spain and France, kind of the same countries where syndicalism was popular. But yeah, I mean, they're generally not major movers and shakers in the business world, and they're not really the source of dynamic growth startups, are not really worker cooperatives either. But yeah, if it's a very well established industry with not too much growth, they could work. But again, you're trading off, similar to social market economy, you are trading off upside potential and long-term thinking in exchange for worker harmony and more social stability, or just less tension between workers in management and workers amongst themselves. Freakonomics was a book. I remember reading this book when I was in high school, when it came out in 2005. It was written by Stephen E. Levitt and Stephen J. Dubner. It was probably one of the most successful in terms of best-selling books on economics that I can remember. And it's really about how you can apply the practice and the study of economics to things that you wouldn't think would be, because economics fundamentally is the study of incentives. And they look into certain circumstances about how the economics underlying of certain niches of the society, which people don't really associate with economic, the more social problems, and how changes in policy have created new incentives that led to a different than expected outcome. The most controversial in this example is the idea of which I think is going to be talked about later in this iceberg, about the role of legalized abortion and its impact in reducing crime. You saw a lot of studies and crime rate data seeing that starting about 16 years after Roe v. Wade became law of the land, and that Supreme Court case took place, you started to see a material drop in crime rates, and that crime rates continued to drop throughout that period. And the argument really that Freakonomics writers made is that people who would have been normally born into tougher circumstances and therefore would have had to pursue a life of crime were never born because they were aborted, because abortion was legal and more easily accessible after Roe v. Wade. That's kind of one example. Another example would be about economic outcomes depending on how your children are named. Like people who have names that are intentionally misspelled or seem like they are from a lower class than other names tend to have worse economic, particularly employment outlooks, because people will judge somebody's resume based on their name. And so there's actually a controversial book that goes more into this that I will put a link in the description if you're curious, that goes into the whole economics of this and etymological origins of it. But that's kind of the idea of Freakonomics. The main criticism is that people thought that it was really just a rationalization for libertarianism, the book as a whole. Its main critics are not really other economists, but more sociologists and criminologists, and they say that they use spurious correlations in to create an economic framework in parts that there aren't there. If you want the full criticism, you can listen to a podcast called If Books Could Kill. But notably, those guys do have a left wing bias, which may have been to impact their criticism. But I would say that's the best recap of why people do not like this book. Then the next thing we're going to talk about in this level of the iceberg is externalities, which I have talked about in environmental economics. I mean, I've noticed a pattern in this iceberg. It's a lot of issues with the environment, and externalities don't always have to be an environmental cause, but that's just the easiest example. Externality is a side effect of an economic decision, positive or negative, that somebody else has to pay other than the buyer or the seller in the transaction. So say if you have a car plant and it's along a river, the seller produces cars and sells them to the buyer who lives in a town 2 states away that this river doesn't flow through. However, really, as a byproduct of this manufacturing of cars, the factory releases all of its toxic pollution into the river. And as a result, the river becomes poisonous, the fish die, people who live down the river have unhealthy drinking water, or just the environment gets damaged due to the lack of biodiversity because of all the plants and the fish and other things in the river dying, and therefore the things that naturally eat those have food shortages, and it creates an environmental mess. However, the car seller doesn't have to pay for that because they pollute in the river because it saves them money versus having to recycle that pollution or to find some way to process that and take care of it so that it doesn't pollute the river. So they save money. They benefit from releasing this narrative externality. The buyer lives 2 states away, is not affected by the consequences of this river, but the people who live down the river and who people who live in that community now have a polluted river are affected. So that's an externality. That's a negative externality. And the way you solve for externalities is that you try to change the economic incentives so that those who participate in the transaction need to compensate those who are being damaged by the externalities, or you penalize them for creating the negative externalities for a third party that had nothing to do with it. So in this case, the government would mandate some sort of regulation that they have to find a way to treat their pollution substances and not dump it in the water. Or if this was a more private system and that river was owned by other property owners in the area, they could take the factory to court for polluting their river and destroying their town. So it's not necessarily a top-down central planning solution to this necessarily, but the externalities do need to be dealt with, because otherwise you're going to have those committing these negative externalities are going to do it without any abandonment, with reckless abandon, because there's no punishment for it. There are very positive externalities too. They're not always negative. Like, say for example, you have an industry, like you have a ranch, and one of the positive externalities is that you have a bunch of fertilizer from your cows that you can use to grow wheat in a different farm. That really, the person buying the meat is not necessarily affected by that unless if that grain is fed to the cows later. But that's I guess a positive example of a positive externality. But generally, externalities when I talk about economics are more about mitigating negative externalities than creating positive externalities. And the next one is the calculation problem. I talk about this in Communism and Socialism, but it's the idea that you can't have bureaucrats and academics, even if they're the smartest minds in the world, they do not know how to properly allocate everything into the economy more than what the market would. Like, if you had, this was the problem with the Soviet Union and a lot of these other Eastern Bloc countries, was that these people who their policymakers had no idea how many cars should be in the dealership, how much loaves of bread should be in each grocery store in every town in the Soviet Union. They didn't really know what the salaries should be for every doctor in every city. I could give a bunch of examples, but that was what, like, the market is better at weighing and making these decisions on a collective basis than having some sort of bureaucrats deciding this, especially if they have no actual practical experience in these fields as a market participant. The main argument against the calculation problem is one of technology. It's like, now with AI and big data and a history of collecting this data over the last decade, could the AI or an artificial intelligence supercomputer solve the calculation problem and actually know what it is? Like, but I don't think people are perfectly rational, or it can predict the emotion. I don't think a computer can predict the emotional swings of consumer purchasing power, like the exact trade-off that every person has to buy something that's more expensive versus a cheaper substitute. I think this would be very difficult even with an AI. So I think you're going to see people challenge this critique of the calculation problem more frequently as AI continues to capture the public imagination. The next one we're going to talk about is Austrian Economics. Austrian Economics, arguably along with Marxist economics, are the two most popular heterodox schools of economics, and they happen to be on the opposite side of the spectrum on the capitalism versus communism debate. The reason why it's called the Austrian School of Economics is because a lot of its early thinkers, such as Ludwig von Mises, Friedrich Hayek, and Karl Menger, all happen to be from Austria. However, today, Austrian economics is most studied and practiced in the United States of America, with the leading universities of Austrian economics include Auburn University in Alabama, where the Ludwig von Mises Institute is, New York University, Loyola, New Orleans, and George Mason. Austrian economics is something I have some personal sympathies for, but I would not really consider myself an Austrian because I think a lot of their analysis and framework is flawed for a variety of reasons. The first really thing with Austrian economics is the idea that, and this is coming out of the book Human Action by Ludwig von Mises, that people are individuals and not collectives, and so therefore you cannot really accurately predict or measure aggregate supply, aggregate demand, and how people react to shifts in those, because everybody has different preferences. People are people. People do not act in groups. And that applies to microeconomics as well. And so as a result, Mises mentioned this whole idea that you have to have a subjective framework, like a, for lack of a better term, a postmodern economics in a way, which he called praxeology, which is actually a topic in the next iceberg, so I'll elaborate more on that there. But praxeology really is my main issue with Austrian economics. It's the idea that economic truths have to be can only really be done a priori through theoretical economic truth and deductive reasoning and thought experiments. Those would be just as accurate as an econometric model, if not more, because you can't quantify human action. And so they heavily argue against econometrics or any sort of way to add data or mathematics or like any way to make it more scientific. And even as somebody who does have a sympathy for the policy outcomes of Austrian economics, if you can't really back it up, or at least don't try to back it up with some sort of empirical data, how is this different than philosophy or theology or any sort of other things that's just solely based on a priori knowledge? That's my critique issue with Austrian economics personally. However, maybe they're the more honest ones. And if you go back to the political economy argument that I've mentioned several times on this channel, maybe all schools of economics are really there to just justify a pre-given policy solution, and you just create the framework. And maybe the traditional economists think that if you put a bunch of pointless math equations behind it, then voila, my theories sound more scientific and official because I can fit it into a nifty equation and math problem. And that would be the Austrian critique of the quantification of economics, or really just my critique of where I think that praxeology could, if you're going to argue for it, that's how you would argue for it. You have other things that I do like about Austrian economics, though, is its emphasis on opportunity costs. They were really the first ones to really impact that into economic analysis, and has since been adopted by the mainstream. The idea that everything that is done now, economic action or not economic action, has a consequence versus the thing you couldn't do. So say, for example, you decide to start a business, and by quitting your job and deciding business, you're giving up the opportunity cost of that salary from your stable job and the upside potentially from that for the freedom of starting the business and the potential further upside in the long run. The same thing with buying a house. If you buy a house in a certain city, you now no longer have those funds to buy the same house or a different house in another city. And that's opportunity cost. And I think Austrians have really been the first to kind of dive into that. The other thing is their definition of inflation. The traditional neoclassical definition of inflation is just using the CPI and just saying, oh, the change in CPI over this period is inflation. Whereas the Austrian definition of inflation is just the increase in the quantity of money. Even if it hasn't shown up yet, the CPI is lagging. And so the inflation has already happened. It's just where it's going to express. And the Austrians make the correct point, is that inflation is not evenly distributed in the CPI basket. So if the government prints 40% of the currency in a year, and that doesn't show up in a 40% increase in the CPI, that doesn't mean the inflation didn't happen. Maybe that was put into speculative assets and we have an asset bubble now. Maybe it was all put into real estate and we've seen real estate inflation now at 70% and everything else is at zero. And it just averages out to a CPI, really, with real estate being about 40% of the basket. It ends with a CPI of only 28%, even though you've seen all that money really increase a 70% increase in housing. So I actually think that the Austrian definition of inflation is probably the better one in terms of actually how much the value of money has declined, just because the fiat currency world, or it's really in any monetary system, the value of money is really its scarcity of supply, what it comes down to it, and on a relative basis to other money. That's why the Austrians tend to be very pro-gold and pro-gold standard, because the government cannot use seigniorage on gold. The supply of gold is relatively fixed. Sure, it grows from new mining, but mining is consistently maybe increases supply about 2 or 3% a year. It's not really going to, especially in the level of how much we've already drilled out all the quote-unquote easy ore out there. It's going to, until gold asteroids are viable to start mining, which may actually kind of destroy the Austrian argument, but we're a long ways from that. The relative constancy of gold makes it a much more better way to benchmark your money because it's actually a store of value. And also, this is why Austrians tend to be sympathetic to things such as Bitcoin, because Bitcoin tries to digitally hard code that fixed scarcity of gold. And I think the most valuable contribution to Austrian economics, the Austrian business cycle theory, is that central banks, and particularly the effects of the central banks on monetary policy impacting the growth of credit from the private sector banks, is what causes business cycles. So if you artificially hold interest rates low, that increases credit more than it would be in a normal economic circumstances when interest rates are at whatever the market would dictate them. That causes a speculative boom. That causes a lot more capital to be flooded in the system that would be normally. That creates excesses, and along with animal spirits and speculation, that propels it forward. And that keeps going until either the central bank raises interest rates above the equilibrium rate to try to stave off inflation, or even if the central bank doesn't do anything, eventually you're going to need to pay back that newly created money supply with interest on top of it. And if the economy actually fundamentally didn't grow enough to pay the interest, which is every cycle eventually gets to that point, it creates a debt deflationary bust, and all of the gains from upside go back down. And that is how the Austrian business cycle works. The Austrian business cycle is a more accurate reflection of things such as the financial crisis in 2008 than the conventional business cycle would. And it really pins the issues of the central banks trying to central plan the money supply and the price of money. As a result, really, with the Austrians' critique of central banking, the Austrians' positive view on gold versus fiat currency, and the Austrian general view that since you can't quantify things accurately or make models, you can't really expect a central planner to be able to do anything efficiently just based on a priori. They really believe in no government intervention or absolute minimum government intervention in the economy, because only people individually know how to make the right economic decisions for themselves, and therefore that results in the most efficiently allocated economy. And they are probably right on this in a theoretical model. The other concern I have with Austrian economics, not because I necessarily agree with this, but just the reality of the world, we've had so many decades of governments fighting, letting the inevitable Austrian bust fully play out and the markets get to the clearing level where you can have a healthy foundation for growth. As a result, you've created a society that's heavily dependent on easy money, whether that is through people living off of social welfare payments who otherwise wouldn't be able to financially support themselves, or you have a lot of businesses who've borrowed a lot of money based on lower interest rates, and now that interest rates are up, their revenues can't even pay down their principal. Sometimes they can't even cover their interest, and these are what we know as zombie companies. And if we did do an Austrian, sure, let's have everything clear in the next crisis, we decided to go full Austrian and everybody went behind it, there's a real chance the society doesn't recover because so many people are dependent on all these manipulations of the market that those who are no longer financially viable getting cut off, they might just start marauding the streets and violently acting out, and society just kills each other from the withdrawal. It's kind of like a drug addict being cut cold turkey. In theory, cold turkey is really the best solution to addiction. But if your system is so heavily dependent, like biochemically, to that substance, a lot of times when people try to go cold turkey from substance that they've been abusing, they often die because their bodies become so dependent on it. They cannot really, their body's adapted to functioning with it. They don't have the hormonal balance or the other things that they're needed to be functioning. So like a lot of doctors would solve this problem by slowly weaning somebody off of the addictive substance. And sometimes that doesn't even work if the patient's too far gone. And that is the main risk also of Austrian economics. And again, I'm somebody who would think an Austrian style market clearing event would probably be a great way to create a healthier foundation after the next down cycle. However, maybe our society is so dependent on easy money and the amount of excess government spending that's been enabled by it that if we tried that today, the patient would just die and the country would collapse into anarchy or civil war or something worse. So, yeah, that's my thoughts on Austrian economics. I may split this just as a separate video because I've wanted to talk about my views on this for a while. The next one is Picketty greater than G. This is from a book, Capital in the 21st Century, written by Thomas Picketty. This book really kind of triggered the whole revival of the income inequality debate, which was a really popular thing in the 2010s before the pandemic, where you saw the Gini coefficient in the United States as high as it was during the Gilded Age, and people were complaining about how young people can't get ahead or the rich are getting everything and the gap between rich and poor are wide. And Thomas Piketty, through his book, tried to create an economic framework on why this is happening and a set of policy solutions to justify his goal of lowering income inequality. I did a video about income inequality, which I'll have in the description, where I argue that income inequality in itself is not fundamentally a bad thing. So that's where my bias comes from. I'm going to try to be unbiased when I explain this. So the main flaw he has with the whole capitalist growth model is that the idea that the required return on investment, which is R, is structurally greater than G, which is nominal GDP growth rates. Like if you look at, for example, like S&P 500 returns over the last 10 years, about 10% a year, versus nominal GDP in the United States, which is about 5% a year on average, you see that there's been a lot more return to investors than there has been in actual economic growth. And so therefore, if you have a society whose wages generally grow with nominal GDP, where then versus investors whose returns increase by the R, then you're going to have perpetually widening inequality as long as there's economic growth. And that is kind of his argument fundamentally, is that unless if you change that equation, economic growth is not necessarily good because it creates more inequality. Well, there's a few flaws to this logic. First, he's only talking about when the market goes up. In a recession, let's just say nominal GDP is flat in a recession. Oftentimes it's still positive because of inflation, but even in the GFC, when you had 0% inflation and its worst a 6% annualized pace of contraction, it was -6. The stock market was down 50%, and real estate prices were down nationwide 40 to 50%, depending on what city you were in. So it's a double-sided coin. When markets are down and the economy is doing bad, that G is higher than the R. But they only look at it on one side. The other thing is a lot of this spread inequality is also, as I mentioned in my video, a product of increased longevity. If people are living longer, they have more years to compound their savings, and so therefore their wealth is growing more. I mean, I would like to see the Gini coefficient among age groups and see if that is materially different. The second is that you had a perpetually falling interest rates for 30 years, and you have a cycle of lower rates lower the required return on investment, the R, and that increases valuations. And if the wealthy tend to have more assets, and so their assets are going up because of this, and therefore the inequality widens. So if you had a period of rising interest rates like the 70s, you had massive drops of inequality because asset prices fell, but wages were going up because of inflation. So a lot of it is just maybe him just zooming in from 1980 to when his book was written in the early 2010s, which is a period that interest rates were perpetually going down. If he looked at a different cycle, it would have painted a different outcome. And what's going on currently with interest rates and inflation and other supply and demand dynamics, it looks like we could be seeing the reverse interest rate cycle that we saw from 1980 to 2020, and it would kind of debunk a lot of his theory. And even if R is greater than G, why is that necessarily a bad thing? Investors need to be compensated for taking risk. If R was less than G, why would anybody take any risk and not just buy treasury bonds? They wouldn't, because they're not getting paid for it. Investors are rational to a point that they're not going to take risk even if they expect to lose money. That's called gambling. You go to Las Vegas, that's what that's built off of. People will just stop investing and you'll have your own fair share of problems. And usually there's a good book about this, which I think I mentioned in my 1-minute book reviews, but it really kind of, I'll put the title in the description, just I'm lost off the top of my head, but there's an economist who analyzed the periods in history when income inequality went down, and they were always associated with crises, whether it was a war, whether it was a major financial crisis, or a civil war, or famine, or something bad, because income inequality doesn't generally go down from more prosperity. Income inequality historically goes down when the capital stock is destroyed, and therefore the rich who own the capital lose their wealth due to capital destruction or the government seizing their money. And Picketty doesn't really seem to realize that he is basically calling for a collective reduction of living standards. I mean, fine, you have more equality, but everybody equally poor, is that really a better outcome than a society where living standards are generally going up, but some people are gaining more than others? Food for thought. The next one is rational expectations, which is something that the Austrians certainly don't like. It's the idea that individuals make economic decisions in a rational way. Example with the investors. Investors will not invest if they're not compensated to take the risk, or people will not buy something if their utility from buying it is not higher than the value that they have of keeping the money. In practice, this probably is not true because, and that's what the whole field of behavioral economics is based on, is people make irrational decisions all the time. Again, look at the existence of Las Vegas, or the fact that the financial markets are not efficient as good examples of that. But nevertheless, you have to have the rational expectations to create models, because maybe every individual may not be rational, but if you have the extreme irrational on one side of the rationality scale or the other, in theory they should cancel each other out. I'm not really sure if this is entirely true. I mean, there are a lot of research to show that, such as books written by Dan Ariely and the work of Richard Thaler in behavioral economics, or even a book called The Myth of the Rational Voter, talking about irrational voting patterns that are consistent even as people get more informed and as economic circumstances change. That there are certain behavioral trip-ups that people consistently make, and maybe those need to be factored into economic models more accurately. The last one on this is modern monetary theory, which is another heterodox school of economics that has pretty much the opposite policy solutions to Austrian economics. And its main idea is that the government issues its own fiat money, and because of that, the government can never default on its debt. And also, the government can always print as much money as they want to pay all of their debts. So the government doesn't ever have to physically balance a budget, because they can just print the money with really no consequence. The only consequence is inflation. And inflation is really the sign that you are producing too much money. And instead of trying to use monetary policy and fiscal policy to control economic growth, you can instead have unlimited fiscal policy, and you try to control the rate of inflation. And the way you control the rate of inflation is either through taxation, not through interest rate policy. There's no, in modern monetary world, You don't need to raise rates. You don't need to cut government spending. You really just play around the tax rate instead. And so and also modern monetary theorists believe that there should not be any unemployment. The fact that there's an unemployment rate, which means the government is underspending, is not fully maximizing the potential of the economy. And as a result, one of the policy solutions for modern monetary theory is that the government should have guaranteed jobs for anybody who can't find a job in the private sector, because they can. And full employment is a goal, so that everybody is able to support themselves. That's and so they control the tax rate. So if, say, for example, if inflation is too high, you raise taxes, particularly though taxes on those with the most money to spend. And so as a result, if people don't have money to spend anymore, their disposable income is down because taxes are high, then inflation will come down because there's less demand. In modern monetary theory world, inflation is demand pull. And so therefore, if there's no demand to pull the inflation will come down. And say, for example, inflation is too low and the economy is in recession because nobody has any money to spend, then the solution would be either to increase government spending or to cut taxes. And the cycle repeats. Like, instead of the Fed, which tries to manage the economy through raising and lowering interest rates, the modern monetary theorists believe you do that by fiscal policy, particularly raising and lowering taxes. The main real issue for this is that mainstream economists think that, one, first of all, there's a ceiling of how high you can raise taxes. Like, above a certain level, people will either move or simply not produce. And I guess in theory, you could cut them right back again to get people to produce. But if you keep doing this over and over again to play around with the economy, who's going to start a business if there's a risk that their tax rate goes up to 90% to slow down inflation from a government refusing to cut spending? It makes it very hard to make business decisions if the tax rates are constantly fluctuating. Also, they basically just encourage universal basic income or guaranteed jobs, and having the government print to pay for it, and that's going to be very inflationary. I mean, we kind of experimented with MMT Light with all the stimulus packages around the world in response to the pandemic, and the result was 40-year high inflation. And really, ever since you've had that spike of inflation, modern monetary theory has all of a sudden become a lot less popular. And I think the reason it did become popular because when Bernie Sanders was running for president in 2016 and 2020, there was no way he could have justified his fiscal policy using any mainstream economic framework. And so, in order to have what is like, again, put a rubber stamp behind your policy goals, Reagan did this with trickle-down economics, and Bernie did this with MMT. I did a whole video of this called The Political Economy. You have to find somebody who creates a framework that says that your policies will not destroy the economy, and in fact will be good for the economy, and that achieving your social goals is also the best for the long-term economic outlook. And so that's why Bernie hires Stephanie Kelton, who's a Stony Brook professor who has been one of the leaders of modern monetary theory, along with Warren Mosler, who was the previous most popular voice in monetary theory before Kelton became more popular due to her becoming the official economic advisor for the Sanders campaign. But that is modern monetary theory. It's really that deficits don't matter. Inflation is just the idea of whether the government there's too much demand in the economy or not. And you use tax rates, and particularly raising taxes, not cutting spending or raising interest rates, as the means to keep the economy in check. It basically just gives the government a free card to do whatever they want, and it means that playing around with it. So it's, as you see, as people have tried this on the light level, similar to Keynesianism in the sense. Yeah, the governments like the idea of I could spend when I want, especially during downtimes, but when it's time to do the other side of it, which is raise taxes to extremely high levels to keep inflation in check, either there's no political will to do it, or these policymakers aren't for it, and so therefore the whole system falls apart because it relies on politicians to have to do the hard thing. The Doughnut-Levitt hypothesis, which I did talk about when I discussed Freakonomics, it's really the idea of that legalizing abortion lowered crime rates due to those who were born into dire circumstances such as abject poverty were never born, and so they never grew up to be teenagers who would later commit crimes. And so, like, what the Doughnut-Levitt hypothesis really goes into is they saw how, like, starting about 15 to 16 years after Roe v. Wade was made law of the land, you started to see a dramatic plunge in crime. And if it's usually mid-teens or when peak age for petty criminal behavior between basically 16 to 24 years old statistically for young men to commit crimes. So they conclude that just less of these future potential criminals being born therefore lowers the crime rate. This is controversial in a lot of ways. Pro-life people do not like it because it is a justification saying that cracking the eggs are worth making the omelet, in terms of, like, even if, like, these people could have become the next great inventors or thinkers or philosophers or businessmen or women. Was it fair to take away their life because our society has less crime? And whereas those on the left criticize it because it just caters to stereotypes that those from disadvantaged backgrounds who are more likely to have abortions also happen to be likely to be criminal behaviors, and they think it fails to tackle other potential systematic causes of crime that are not as obvious. I already talked about that. So let's move on to the next one, which is Praxeology, which is my main beef with Austrian Economics. Praxeology is really the idea that theory and human action is that people do purposeful behavior, not just random behavior or reactionary reflexive behavior based on their circumstances. And how this applies to economics is that because every person alive has a different purpose and different goals, you cannot quantify people in the aggregate. And since you cannot quantify people in the aggregate, you cannot use econometrics or any sort of quantitative models to make predictions or observations about the economy. Every economic theory has to be just judged on its a priori or rhetorical merits. And this is really just inherently a rejection of empiricism and the scientific method. And it's also just, if you want to actually try to solve issues in the economy, wouldn't it be good if you can actually statistically back what you're trying to say? I think this is just a cop-out saying, oh, since people are individuals inherently, we can't make any conclusions about what collect people do on the aggregate because we just rather just philosophize and not have to actually back up our theories. And this is somebody who has a pro-market Austrian policy perspective on a lot of things, but I mean, I think especially in the age of big data, where you can run back and test your hypotheses in real world circumstances, not just in a college classroom, I think it's a very intellectually dishonest approach. And those who are pro-praxeology, feel free to make your arguments in the comments. I have read Human Action, so I would happily make this a dialogue. The next thing I would like to discuss on this tier is anarchist economics. Surprisingly, anarchy isn't really just as simple as I don't want a government. There are multiple ways you can have an anarchist society. The two most notable ones, which I'm going to talk about, are anarcho-capitalists, or the ANCAP movement, or anarcho-collectivists, which is more traditional anarchism. We think of the radical, borderline terrorist movements in the turn of the 20th century. Like, I think it was an anarchist who shot President McKinley. But with anarcho-capitalism is the idea that you have no government, but you still have a free market, and the free market and private businesses replace all the services that the state would. And some services probably could be done better in the private sector than the government has. But the main flaw with anarcho-capitalism is that there are a few core services that if you had them essentially outsourced to either insurance companies or private security companies, those companies will either conduct M&A with each other or compete with each other, or maybe even with violence to gain a monopoly. And if you have a monopoly on violence or guaranteeing security, that effectively makes you a state. And also the other flaw with anarcho-capitalism is that it has to be global, because even if one country just maintains a state and everybody else is anarcho-capitalist, eventually the organization of the state or those places in the world which still operate under a state system will just conquer the ANCAP countries, or the ANCAP countries will effectively have to make a government and a military to fight off invaders. And that's not even going to other issues. I think the main way to really kind of defeat the argument for anarcho-capitalism is the idea of privatizing security. And then with courts, there's also a difficulty of that, is that who is going to enforce a ruling? I guess your reputation, like a credit score, can, but if the cost of complying for the loser is big enough and there's no legal means to enforce that claim, then big losers of lawsuits are just not going to comply. And what out of the criminal penal system is the same thing. And then you could also have it in a way that it's not really a free and fair legal system too. Like, it's very easy to probably manipulate that with whichever the plaintiff or the defendant has more funds will have an advantage of choosing the arbiter. I guess you could use Yelp reviews. I'm not going to get into ANCAP arguments, but the fundamental flaw is that inevitably whoever's in charge of defense is going to consolidate and become a state. And instead of having the federal government be in charge, you have an insurance company. I actually are examples of, maybe not insurance company, but company rule in other places, such as what happened with the Dutch and British East India companies in India and Indonesia. But yeah, that's anarcho-capitalism. It's the idea that there is no government, but there still is a fully functioning free market economy that everybody voluntarily participates in. And I think it sounds great in theory, don't get me wrong, but I think anarcho-capitalism is the communist of the right. Like, the difference is that really anarcho-capitalism really hasn't been tried on a major country, like, for long enough a period of time to see how it actually works. But given just the theoretical flaws of it, that's probably a good thing it hasn't been tried on a mass scale. But yeah, the next one is anarcho-collectivism, which is traditional anarchism, which is not just the abolition of government like the ANCAPs want. They also want the abolition of private property. So it's really just kind of complete chaos. There is no ownership. Nobody owns anything. People, if they want to get things done in an anarchist system, everybody has to work together and equally share or figure out a fair way of doing it without nobody having sort of unfair or predetermined claim on any property. Because in an anarchist system, who's going to enforce property rights? In an anarcho-capitalist system, in theory, you have arbitration run by private companies and a private court system, and private insurance companies or private security companies maintain property rights. But in a pure anarchist system, there wouldn't really be any of those things because there wouldn't be private industry. So there's no property, because there is nobody enforcing property rights. There are no property rights. I mean, it sounds to me like a giant tragedy of the commons is how that would turn out. And there have been attempts to try to do anarchist societies, but none of them have really ever worked. I don't really know where I would put, I think, and also like pure communism, like in the most idealized form, would be considered this type of anarchist ideology. The main critiques that anarchists have of Marxism and communism is the whole transition stage where it requires an authoritarian state to control all the means of productions, and that they would never really be able to drop that. And that is exactly, the anarchists were correct about that. If you've seen what happened in the history of the Soviet Union and China and other places that did get to that intermediate stage but never really, quote unquote, crossed the finish line. Now, after anarchist economics, the next one we're going to be speaking of Marx is the transformation problem. The transformation problem is the contradiction between Karl Marx's labor theory of value, which is basically the idea that the value of something is based on how much labor it costs to produce it from its raw material state, or if it's a raw material, the amount of labor it costs to extract the raw material, versus the idea that profit rates tend to equalize among industries, and that capital-intensive industries tend to have higher profit margins than labor-heavy industries, even if you adjust and take wages out of the calculations. Like, that's the problem, is that, and also companies with smaller labor forces per dollar, or more money per worker if you inverse it, tend to also be more profitable. Like, when a company that requires, if the labor is the driver of value, a company that spends the most on labor should in theory be the most profitable company, but that's not really how it works in the real world. Like, big tech companies are a good example of this, actually. They have some of the lowest amounts of labor per $1 billion of revenue generated, and based on Marx's theory of value, that really shouldn't happen. That's the transformation problem. And really, Marx really tries to factor the account really for this in a variety of theoretical ways, saying that a lot of production has failed to transform the inputs. Also, the fact that the market prices change, too. Like, if something all of a sudden becomes outdated, like, for example, building a fax machine. So, if the cost of making a fax machine is still $50 of labor time, but now fax machines are worthless because nobody needs a fax machine anymore, does that mean that that labor was worth nothing, or is the fax machine still worth $50? You can see where there's a problem here. And the resolve the contradiction is really just that every industry still receives the same profit in a way that's consistent of labor of value, but the price of production is basically a sum of mathematical formulas based to try to factor this in. But the bottom line is it shows the main flaw in the labor theory of value. The next thing we're going to be talking about is supply side economics, which is kind of like, I've been criticizing a lot of people on the left for trying to shoehorn in their environmental or income inequality concerns into economics by creating an ideology that's saying that addressing those concerns are actually the best way to manage an economy, and we can prove it through X, Y, and Z formula. Well, supply side economics is kind of like the right wing version of, I have an ideological goal and I need to build an economic and mathematical framework to justify it. And it's the idea that, like, instead of Keynesians, whose goal is to fix the economy by manipulating demand one way or the other, is that instead, if you want to have consistent economic growth, you make it so that the cost of increasing supply is low, and so therefore businesses will produce more supply. And so because in supply, there's more supply produced, prices fall, and therefore inflation drops, and therefore consumers have more disposable income, and that extra disposable income can be spent in other parts of the economy, and therefore drive economic growth by just producing more and more stuff at lower and lower costs. There, this sounds terrific, and it has worked in a variety of industries. I think the problem really with this is that the mechanism isn't really perfectly translated. Like, the way apparently to create these all these bottlenecks is deregulation, which I do agree that part of it generally does work if you get rid of a lot of regulations that mainly just slow production without really doing much to resolve the externalities that those regulations were written to address. But the other key of it is just lowering taxes. So I say if you lower taxes effectively, that lowers the amount of money you need to make to have the same after-tax profits. And if lower taxes after tax, you don't need as much pre-tax profit margin to get the same after-tax profit margin. So as a result, companies will have more capital to produce more supply and can sell at lower prices because you have even less money is going into taxes. But there's what's to say that, and this is the issue with trickle-down economics really fundamentally, is that what's to say that the companies will actually do that with the lower taxes instead of just keeping the prices where they're at and pocketing the difference, or using that extra amount of profits to, instead of to increase supply, to decrease supply through buying competitors and then using their higher concentration in the market to cut supply and have a more monopolistic environment. So yeah, it's kind of in theory. And also the other problem is really not necessarily, if this was just cutting taxes is fine if the government cuts enough spending to keep the budget balanced. But my main issue with supply side economics is not the idea of lowering taxes. It's actually, all things equal, probably a net better world for the economy and for individual freedom. The problem is you can't cut taxes without cutting spending. It's kind of like Keynesianism in reverse, where Keynesian solution is to increase government spending, but they fail to increase taxes or cut spending on the upcycle, even though they do all the stimulus on the down cycle. Supply side is the reverse. Okay, cut taxes when the economy is down to stimulate it, but then when the economy is doing good, you don't cut the government spending to rebalance the budget, or in fact actually to generate surplus to pay back the deficits generated from the bad times. And that was really the fundamental problem, is that Reagan was unable to get Congress to pass spending cuts. And in fact, Reagan wanted to increase defense spending at this time while cutting taxes, and therefore he widened the deficits. And that has led to our current debt problems, and as an extension that will eventually be paid, and those taxes will go up, but instead of seeing a higher income tax rate on your tax return, those taxes will be paid through higher inflation. So it's really just, instead of being honest about it, that's really the end outcome of deficit spending, is higher inflation. And that's my critique of supply side economics. Doughnut Economics is another environmental economics theory where there's kind of an opportune zone which is kind of shaped like a donut, which is the balance between economic growth and environmental regulation to keep that growth sustainable. If you have too much environmental regulation and you fill up the hole in the donut, then you get an economy that is stagnant and causes a lot of social problems that are far worse than the marginally cleaner environment as a result of tightening environmental regulations. Whereas the other side, let's just say if the donut is environmental regulations are too loose and you prioritize economic growth and target that, then the damage of the environment through pollution or climate change or other adverse negative externalities of modern industry and economic development, the damage from that, especially in the long term, if you calculate the future value of it, will be much more harmful than the marginal amount of economic growth you get from deregulating environmental policy. And this donut is the ring in the middle between being too restrictive on environmental policies and being too loose on environmental policies, and therefore destroying your environment just for not enough growth to justify it. And the last one is supercapitalism. Supercapitalism was a term introduced by Benito Mussolini, a speech he gave in November 1933, where he discusses the stages of capitalism, where you had early stage capitalism called heroic capitalism, where it was the building and foundation of modern industry. And then static capitalism was when those industries became mature, and the gains translated into mass society, but at the same time is kind of unevenly distributed. And then you had the final form, which is decadent capitalism, which is the idea is that it's this capitalist economy that is just really designed to sell to people's worst instincts and push mass consumption at the expense of actually like promoting human flourish. It's really super capitalism is just like the macho fascistic way of saying late stage capitalism, which is this idea you hear a lot about on memes on the internet where, oh, like capitalism isn't really working anymore, and so they just do these more desperate things to cater to the lowest and lowest denominators to keep people spending for things they never wanted, to impress people they don't like. Like a good like movie that kind of summarizes the ethos of the late stage capitalism anxiety was 1998's Fight Club. What happened with Edward Norton's character and his obsession with furniture until he joined Fight Club and kind of let go of all of it. I'm not going to spoil too much of it, but Fight Club is, and the ethos of Fight Club is the same kind of critique of late stage capitalism that Benito Mussolini had for super capitalism in a way. He wanted a more corporatist economy, which is really one of the roots of fascism, where the state and the government, even though the government doesn't own the companies, but the private industry will work with the state to help accomplish the state's goals. One collective body or a corpus, which is where the word corporatism comes from. State economics really is the idea the same amount of output. And the economist who's most notable for this is a guy named Herman Daly. And it's really, you have a constant stock of capital, a constant stock of people, and you maintain those similar levels through selective policy measures to make sure that the economy stays at the current state. The reason really for this is partially due to Daly's and steady state advocates' criticism of just consumerism broadly, and they feel like living standards are sufficiently high enough even back in the 70s when this first got drafted, and people should just be learned to live okay within their means, and as long as we don't have a decline from here, we should be fine. The second thing is just environmental concerns again. If you have the economy not growing, it means you're not increasing the rate of damage to the environment. And it's more practical than, say, the next term that we're going to talk about, like, which is degrowth economics, which is actually starting to cut and have a target of actually lowering the size of the economy. So it's kind of, I think of steady state economics as kind of like the moderate version of degrowth. It's just the goal is really just to kind of keep it the same, but it's also steady state economy is really just making an ideological platform to try to achieve a goal of the idea of caterers paribus, all things equal. We use it as a theoretical like example of like what would happen if you did bring in an exogenous variable to change the current economy, the steady state, the default. It's the null hypothesis really in economics, but there's also a actual goal of creating a steady state economy. So it could mean both things. And speaking of that, next one is we're going to talk about is degrowth. Degrowth economics is the idea that due to shortages in natural resources and environmental damage, peak oil, and the declines of megafauna and a lot of other real concerns, which is resource consumption in the environment, that the goal should not really be to grow the economy, but actually to shrink the economy and the damage and the consumption of natural resources of humanity. A more moderate form of this would be really, the goal would be to try to keep consumption the same outright in terms of living standards, but use technological innovation to use less resources for the same amount of goods and services. That's I think, what most people would advocating for who are advocating for degrowth, but more extreme advocates of degrowth want just outright just decline of the ecological footprint at any cost. And they'd say like, hey, we have to cut resources by X amount. It doesn't matter if you have to cut output if you can't do it in efficiency gains alone. Climate change or other environmental disasters are that dire. We don't have the luxury to be patient at a steady state. So really the debate in this field of the degrowth advocates is how fast to go about doing it, even though they all have the same end goal, which is to reduce the amount of resources being used. And it's also associated with a lot of other progressive causes because apparently excess economic growth creates inequality, which I've talked about already with Thomas Picketty. But yeah, degrowth really hasn't been tried in any meaningful way. I mean, companies, of course, try to do it just to increase profit margins, but on a countrywide level, it has. The main criticism, really, of degrowth is who are these policy elites advocating for it have the right to say how good of a standard of living is good enough. It's the same criticism of steady state. And there's also been a lot of positive benefits to economic growth. If it wasn't for economic growth, we wouldn't have a lot of cures for a lot of diseases, which a generation or two ago would have been an instant death sentence. Now you have longer lifespans because of economic growth. You have a lot higher quality of life due to things such as the internet, making all of our lives easier. Like if it wasn't for economic growth, you wouldn't be able to watch me summarize this iceberg right now, or even the person wouldn't be able to make this iceberg. You'd have had to find some obscure textbook at the library about each one of these topics. And if the degrowth people got what they wanted when this first started to become popular in the 60s and the 70s. And there's also a political component. If you are going to degrow, who eats the burden of that? Is it just the people who in your political opposition are the ones who are going to have to cut their living standards first? Is it going to be those who are historically disadvantaged or historically advantaged, or people who live in geographies that are more environmentally degraded than others? Like, yeah, the politics, a lot of it is just a measure of who eats the brunts of losses of change. And this would be no different. How would you decide that? But yeah, overall, that's what degrowth economics is. Next, we're going to talk about the Lange-Lerner model of socialism. It's kind of a way to add markets in the end user, but at the same time have the state own every business. So it would be in the sense that the state would own all the property and the means of production. There wouldn't be any private property other than like personal items in this world, but they would let business owners and markets set like the pricing and the desired allocation for goods and services. So if, for example, if people want to buy red umbrellas and the red umbrellas sell out, that's the market signal to make more of those. If the state-owned factory will supply what is demanded, and they'll use the market impulse to determine what end users actually want to buy. But they would still keep the communist model for public ownership and in terms of wealth redistribution and all of that. This has never been tried anywhere, and so we really don't know how it would work. A lot of it, the thing is that you would still, even if you have figured out what the market of demand, there'd be at best a lack, if at worst, the government will have no idea still how much to produce of quantities of goods and services, because just because some people want to buy one thing one week, they may not want to buy it the next. So you're going to always be a step behind. And also, this thing has never really been tested, and there's no really models or framework for it, so it would be hard. There's no way to falsify it. That's the other real main critique of the Lange-Lerner model. And also, what would be the incentive for these vendors to want to generate a Pareto outlook? If you're still going to have, you basically want the bet cake and eat too. You want the the pricing power and the efficiency of perfect competition, but you want all of the social goals and the means of production controlled by the state, as it would be in a socialist economy. Those are fundamentally, I think, irreconcilable. The next real thing we're going to talk about is the inverted yield curve, which we're actually going through an inverted yield curve right as I'm speaking. It might actually become one of the longest inverted yield curves in the history of modern financial markets in the United States. And the yield curve is really just the difference in interest rates over time. A normal yield curve is positive sloping, whereas shorter term debt has lower interest rates than longer term debt. That should make sense because, say, if I wanted to borrow money from my friend and he doesn't trust the ability of me to pay back, or he has to be compensated for the time value of money that the longer I have the money. So therefore, he needs a higher interest rate to compensate for the credit risk of me not paying back, and also to compensate him for the time being locked up and the reinvestment risk of not being able to reinvest that money at a higher return at a future date. So that's why a 10-year bond historically would say yield 4% versus a 2-year bond would yield 2%. An inverted yield curve is when you have the opposites, when the shorter end of the curve is a higher interest rate than the longer end of the curve. So right now in the markets, you have the short-term rates at 5.5%, and you have the 10-year yield at 4%. So you actually are getting compensated more to lend in the short term than in the long term, even though in a normal market, you should want to demand higher interest rate in the future due to the risks I mentioned before. The reason why you have inverted yield curves is because yield curve inversion is anticipation for recession, and as a byproduct of recession, interest rates getting cut. So people will take a lower interest rate now to lock that in. So in the event that the Fed cuts rates and the whole curve steepens again through interest rates dropping, you'll still get that 4%. So say, for example, we hit recession. Fed cuts the front end of the curve from 5.25 to 2%. So therefore, there's people who own short-term debt, when they want to reinvest in short-term debt, they can't get the same yield. Whereas the 10-year will still drop, but it will drop from, say, 4.3%, or it is as I'm recording this, down to, say, to 3.5%. So it's still a positive sloping yield curve, but those people who locked in their interest rates did so because of anticipation of the whole yield curve dropping and steepening through. That's why a yield curve steepens during recessions, because of the cutting of interest rates. That is why a yield curve inverts. And historically, there have been 9 yield curve inversions since the 60s, and 8 of them have resulted in recessions. So far, we haven't had one yet, but it's too early to determine. And the inverted yield curve is a strong sign of why I still believe there's a high probability of a recession within the next 12 months, even as a lot of the market consensus has gotten a lot more optimistic about the future trajectory of the economy. Next, we're going to talk about is Georgism. The next one we're talking about is ecological economics, which I think this is really essentially the same as environmental economics, Doughnut Economics, and green economics, and degrowth. It's not exactly, but it's a similar idea that you need to factor in ecological considerations and negative externalities towards the environment. And then the last one we're going to talk about. Welcome to part 7 of the Iceberg of Economics. This is the final part that I am taking from the Reddit. Parts 8 and 9 will be my own additions to this iceberg. A lot of these concepts I'm not nearly as familiar with. This is a real deep rabbit hole that, I hadn't even heard of a lot of this stuff before I read about for this iceberg. But I'm going to do my best to kind of explain some of these kind of heterodox theories and let you know what I think. The first one is military Keynesianism. It's similar to regular Keynesianism, except instead of using the increased This is in public spending to spend on infrastructure, social welfare, or just to finance tax cuts. The money instead should be used to expanding the military industrial complex and spending more on defense. The most notable example of this would be the defense of the U.S. military industrial conflict post Eisenhower, particularly the Star Wars program with Reagan, or the Third Reich in Germany is also an example where they basically put all their government stimulus efforts into expanding their military. I don't really see why you would want to do this particularly unless you have a national defense reason to do so or fighting a war. I mean, because I think there'd be a lot of problems with this. One, you create like a permanent war economy. And I think that's what the argument is like, oh, during the world wars, or in Germany's case, building up for war, and some of the most prosperous, fastest economic growth in like the history of their countries. But that's not sustainable. You can't just keep building a bunch of tanks, especially if you're not going to use them, because what kind of outcome? You're just creating jobs. Especially if there is no war, building a bunch of tanks and fighter jets does have some deterrence effect, but beyond a certain level, you're just doing a more scientifically advanced and higher paid version of digging holes in the ground and refilling them. So as a result, if you build all this stuff, it'll make politicians and war hawks in your country more incentivized to use them. And wars historically are the worst things for economies in the long term, unless if you win them in such a convincing fashion that all of your rivals are destroyed. But the human and the moral cost and the social cost of fighting wars, and usually the inevitable loss of civil liberties and freedoms that happen to civilians, even of the winning countries, as a result of war and increased taxes and inflation needed to finance wars, are usually a net negative outcome for all parties involved, even the winners of the wars. So I personally don't really like the idea of military Keynesianism as a response to that. I mean, you either need to find a fight to pick, or it just becomes a glorified version of digging a ditch and filling it. There are other ways, like if you're going to try to stimulate the economy, you can give money back to taxpayers to help them allocate it in the best way, more efficient way possible, or you can build infrastructure that can be used by your public domestically, which are both probably better outcomes than military Keynesianism. The next one is recursive economics, which is basically the idea that you have two-period optimization and contingent decision making and game theory applied to general economic models, which neoclassical models usually based on one decision, like I'm going to buy the hamburger today or not. Whereas a recursive model is a two-period one. So maybe if one day you'll buy the hamburger, and then the next day you'll buy chicken. However, maybe if the price of meat goes up more than chicken, you may just skip the hamburger day one, or just go straight to buying chicken the day one, and how that would affect the demand for meat across the board. And basically now with more modern programming abilities, we can build multi-step models to test a lot of this stuff out. If you were trying to do this by hand, like the supply demand models I had to draw in my economics exams in college, these would be a lot harder to do. So that's why this is emerging. I think it's interesting. There really hasn't been that much really proven applicable results that have come out from this based on what I've read. But I think it's an interesting direction for the future of the field. Another one I'd probably put in a similar category is thermoeconomics. Thermoeconomics is the idea of applying the rules of thermodynamics and physics to economies. And I think this could actually apply to sociology too. I think economic and social entropy are real things. And in order to keep a modern society that is growing to continue to be stable and not devolve into a big social mess filled with violence and revolution and just productivity collapsing, you have to put more energy into the society to keep it organized, whether that's through stricter law enforcement or through the economy innovating at a progressively faster rate to have more stuff for everybody to do and to have raise living standards so that people want to still peacefully cooperate with each other. I mean, it's not necessarily physical energy. I think that's the thing with the thermoeconomists get stuck on. It's kind of integrated with peak oil philosophy, and that you just they literally mean you have to put in more literal energy to keep things going. Whereas I think this energy could also translate into human capital deployed the right way, or maintaining a same increase of technological innovation. Or even if with that technological innovation, you could have energy extraction go down. So even if you do need to put more energy, you're not necessarily going to run out. Like, that's the conclusion of the thermoeconomists have seemed to make, is that you could precisely have to put more energy, and there's going to be one point you have peak energy and you run out, and therefore the whole system collapses into anarchy. That's the one step but I think the idea of using the laws of thermodynamics, particularly the concept of entropy for economics and sociology, is overdue and should be applied more. The next one of these we're going to talk about is complexity economics, which is trying to utilize the application of complexity science, which mostly applies to physics. But there's a good book I'm reading right now about complexity economics, not complexity economics, but complexity theory things. It's called Scale, the Universal Laws of Growth, Innovation, and Sustainability, written by Jeffrey West. And this kind of goes more into the science behind complexity theory when it comes to scaling things. And it doesn't apply just to physics, but to biology and economics and urban development and sociological issues too. And complexity economics is just part of this. And again, with advanced big data and quantum computing, we can build theoretical models about how complexity theory factors do impact economic decision making. And it's a rather new and emerging field in economics, and it gives you more creative ways to measure like a health of a country based on other fundamentals outside of just traditional GDP numbers. And it shows that you can build models that have more adaptive variations. And like the example, the most famous one is like a test stock market in Santa Fe. And even with doing it with robotics and algorithms, it still had its own bull markets and deep stock crashes. And yeah, I think this is just the next step to really advancing econometrics. It's just, however, they haven't really been able to use it to really apply anything yet, but I'm watching. It's an interesting idea. And then we're going to talk about anti-natalist economics, which is also going to relate to Malthusianism, which I'm surprised Malthusianism is this deep because it's a very popular and old idea. It's from a British clergyman named Thomas Malthus. It was the idea is that food supply only grows arithmetically, whereas population grows exponentially. Like when times are good and there's a lot of food and wages are high because there's more resources than people, a population tends to grow until the population gets too high to cover the existing food supply. And then you have famine and starvation and tough economic times where people don't have kids because they don't have, because the effective wage due to the gap of supply factors versus people is negative. So people have less kids or don't have kids at all, and the population goes down to the equilibrium. And according to Thomas Malthus, the equilibrium is subsistence, like that the median labor makes just enough to survive and nothing more. And whenever you have a supply shock one way or the other, the population will correct up or down to adjust for that. Malthusianism has largely been debunked because the Industrial Revolution. The Industrial Revolution happened, and Malthus could not predict this. It made the cost of farming a lot cheaper and a lot of their basic needs a lot cheaper. So the supply of food can grow much faster than the supply of people. And especially as living standards rose and families and diseases were cured, or you weren't likely to die young, people had smaller family sizes. And as a result, population is growing far slower than food. Like obesity is now a problem. And so that is Malthusianism. And there's always a lot of neo-Malthusian arguments that maybe we won't run out of food, but due to housing policy, we're going to still have overcrowds. There's going to be too many people, especially now that, say, certain countries have grown past a certain level and they're going to need to consume energy too. And so, because we're going to run out of energy, we're going to run out of housing, we're going to run out of raw materials or whatever. And it's going to cause the same Malthusian trap, except instead of food, it'll be something else that triggers it. And so far, none of these neo-Malthusian triggers have happened yet. And that leads me to the next topic, is Anti-Natalist Economics, which I didn't even know was a thing, but anti-natalism is the idea of policies that discourage people from having children because the world is overpopulated. And I guess the field, there wasn't, like, this is such an obscure form of economics is that they don't even have a Wikipedia page. There is no Anti-Natalist Economics Wikipedia page, but if I just had to summarize it, though, based on what I've read about this subject, it's neo-Malthusianism, or just people who really just think that they're for environmental reasons again. There are too many people. People are, like, the easiest way, if you really wanted to save the environment, is to simply not have kids, because every person you put on the world is going to use raw materials to eventually build their own house, drive their own car, eat all the food that they need or meat or travel, and all that stuff requires energy, which burns fossil fuel, which is bad for the environment. And then they'll have kids that'll do the same thing. And so I think it comes back down to this. I just noticed with this Reddit, a lot of it comes back to just a lot of different schools of thought to help justify a more green approach to assessing economics. I'm not going to go into the merits of that one way or the other, but it seems like a lot of economists are heavily prioritizing climate change and other environmental concerns in their frameworks. And then the last two, one is Japanification is the future of the Western society. Japanification is the idea that Japan had a big boom in the 80s. It busted. Japan's baby boom happened a lot faster than other countries, and their birth rates dropped faster due to the hyper-competitive nature and the very high level of population density in Japan compared to places such as Western Europe and North America. And so they were the first to have the bust of population. Their population peaked and has been starting to go down. And they have way more senior citizens than kids. And so that trend is likely to continue. And there's a lot of implications to this. One, Japanese economic growth is, especially as nominal GDP growth, has kind of gone to a standstill. We've seen just a lot less innovation in Japan in previous generations because there's just less young people in Japan. Housing has become affordable because they're maintaining the existing supply, but the demand is going down because population is going down. And you have the governments that try to compensate for this by racking a bunch of debt for stimulus projects, and it hasn't worked simply just because people are shifting to a lower level of consumption in their post-retirement years. And the amount of government stimulus is not going to do anything. You don't need to build a bridge for people to take road trips from one side of Japan to the other if people are 80 years old and no longer want to get in a car. I mean, that's just one example of many. And so the thing is that due to this same population demographic curves that are in Europe and to a lesser degree in the US, because the US has more space, housing is relatively more affordable, and you have immigration, so that assimilates easier. So as a result, you have much larger young people population in the US compared to other developed countries. But they expect to have the same Japanification, which is weaker financial markets, weaker housing markets. You have lower interest rates because you have a lot more savers than spenders, weak growth, if not flirting with recession constantly, and you have a declining population and you have increased demand for social services and less people to pay for it, and it creates that along with the government's inevitable response for Keynesian stimulus creates an unpayable government debt. That's what is known as Japanification. It's slow death that results in multiple lost decades until the population pyramid normalizes once again. Do I think it's going to happen? I think it's possible. I think it's far more likely in Europe than the US to happen, but still something to watch and keep in mind. It's a common narrative, though, in economics circles. However, it's far from certainty. And then the last one is there's no argument against hyperinflation on solely theoretical grounds. Yeah, that is true. Like, if you really have these over-indebted governments who cannot raise taxes or cut spending to balance their budgets, the only way out really is inflation. And if you want to just rip the Band-Aid off and do it quickly, just do hyperinflation. Just have a few really bad years of inflation, like 30% plus annualized for, I don't know, 4 to 5 years. Or if you want to do it faster, they could 100% in 1 year and double the price level. And you know what? Your government debt would effectively be completely wiped out overnight. That sounds great in theory if you're a government, but if your money loses half of its value in less than 3 years, there's a lot of negative social and economic consequences to that. A lot of middle class people who thought they had a stable retirement no longer do and will have to work longer. Wages definitely won't catch up that fast, so you're going to see material drops in standard of living across the board, except for those who successfully hedged, or the lower classes who are on social assistance anyway, which would likely be indexed to it. But even then, it probably won't. Well, actually, they get actual raw and services and food and things, not payment in cash. But those who get like a universal basic income, they won't see it really catch up with inflation. So it's really effectively a giant expropriation among your citizenry. And yeah, if your economic system, it's the easiest solution to solve a lot of structural government issues, just to wipe out the debt through a round of hyperinflation. Or you could really even argue, if you want to take us to the absurd extreme, if you just killed off the bottom 5% of the population every decade, you'd probably eliminate 90% of the social problems in any society, because most of the social problems are the most economically disadvantaged citizenry, or either the causes or the ones suffering from it. So either way, you're going to eliminate the problem. But yeah, but these don't. There's a human toll to it. The hyperinflation again, families get destroyed. People's time preferences shorten because they don't know if their money will have any value tomorrow. So they'll just buy things now, or live a more morally licentious and less disciplined lifestyle. It's like, why? Like, do you think YOLO was bad now? If you know that like inflation is going to wipe away everything that you've ever worked for, you might as well just live for the now to the extreme. And that lack of the culture destroying its long-term time preferences was devastating for investments, devastating for innovation and growth and a lot of other things. So there's a huge social consequence. But again, on very theoretical, like not impacting the human and emotional toll and how this affects families and businesses and people's livelihoods on an individual level. And then that anger results in political populism and social tension and possibly violence. That's why hyperinflation is a problem, but theoretically, it's not an issue for it. And that's what there is no argument it's hyperinflation on solely theoretical grounds mean. And welcome to Analyzing Finance with Nick. Now we're going deep into the iceberg. Like, it's so deep that it's only me and the submersible behind me. And in this layers, we're talking about our last two parts 8 and part 9. And in this one, we're talking about heterodox economics. Heterodox economics are basically economic theories and philosophies that do not really fit in the mainstream frameworks of economics, which are neoclassicalism, monetarism, or Keynesianism. Some would argue that Austrian economics and Marxism should be considered the fringes of mainstream or the most acceptable forms of heterodox economics. However, since I've really talked about both of those and higher tiers of the iceberg, we're going to go to some of the more crazy theories. The first one of these we're going to talk about is Buddhist economics. Buddhist economics is really the idea of applying the principles of Buddhism to economic thought. They have although quite a bit of differences between traditional economic thought and Buddhist economic thought. One is that Buddhist economists care about the stages after the consumption of a product and how those affect the society and the environment versus just the purchasing decision, which is the dominant framework of traditional economics. Also, traditional economics concentrates on self-interest and rational decision making as the guidance for economics, whereas in Buddhist economics, they don't really believe in the idea of an I or a mine, and that humans need to detach from that theory. And they believe that self-interest based economic approaches will ultimately fail in the long run. So building models based off of those are not effective. It's also why they really don't prioritize things such as profits or the concept of desire and marginal utility. They think that the goals also for markets is not to maximize product saturation and gross national product, but instead to minimize violence, because without markets, people used to just take things from force. So they're kind of a necessary evil in Buddhist economics. And similar to happiness economics, we're going to be talking about later in this iceberg, they don't like to measure economic success on gross national product or GDP, but instead on gross national happiness. That's kind of really it. It's trying to integrate a Buddhist religious framework with modern economics. The next one I'm going to talk about is institutionalist political economy, which is probably among these the iceberg that I could probably get behind the most here in this section. It's the idea that historical and socio-political factors drive the economy versus just pure market decisions. And I think this was more true in ancient history and medieval and Renaissance history, when the state was a much larger actor in the economy and one of the few bigger forces in the economy, when also wars were more prevalent, because you can have the greatest business out there, but if all of your property and equipment get destroyed by a bomb in a war, that's going to change the way that economic structure is involved. So I think that the idea of institutionalist political economy and about how political decision making shapes socioeconomic practices and then creates a feedback loop where the politics drive the economic decisions, which therefore drive the politics, and it creates this cycle. And it kind of, the way I deviate from the main thinkers of this group, which are economists Thorstein Veblen, John Commons, Wesley Mitchell, and John Dewey, is that I think a lot of economic ideologies and economic schools of thought are basically quantified rationales for a specific economic policy goal, which I've talked about in my video, Macroeconomics is Political, which I'll have a link to in this description. The next one I'm going to talk about is feminist economics. Is really the idea that traditional economics doesn't really factor in gender-aware issues and about how the difference in the way that women and men navigate their lives affects economic outcomes and distributions of assets and wealth and economic opportunities and other things like that. They're very in a lot of the more mainstream feminist economics, economists for lack of a better term, really want to have some sort of measurement of gender empowerment called the gender empowerment measure to see how fairly women are treated in the broader economy. They also call attention to like a lot of social constructs and expectations for men and women and how that affects decision making and economic decisions, mostly on the micro level, but also occasionally will branch into macroeconomics. And feminist economics prioritizes the goal of enhancing the well-being of children, women, and men in local, national, and transnational communities over just maximizing just the overall total output of an economy. They just also think that, again, the utility function is so much different between the genders that you cannot use like measuring utility as a marginal utility as a way to determine economic decisions. And they also think that traditional economics believe that the heads of households will act in an altruistic way for the benefit of the family as a whole, even though they think that might not be true. Ironically, the most feminist economist that I was familiar with before I even understood this concept, I don't think he would call himself this, is actually Aaron Clarey. He's not like necessarily a feminist economist in the sense that he believes in the political ideology of feminism, but a lot of his economic philosophies and ideas revolve around gender dynamics and how gender dynamics influence economic decision making. The most famous one of these, at least the one I found the most interesting and unique, was the idea of coma, which is it's the idea that a wealthy man would sponsor his spouse's business even if it doesn't make a profit, simply to just give her something to do. There isn't really economic studies to confirm the prevalence of coma, but if you see a lot of knickknack shops in wealthy and touristy areas that in a normal economy have no idea of making a profit and then just disappear in a few years, that might be coma in action. So that's my kind of unconventional take on who's the leader of feminist economics in an unintentional way. The next one is this idea called Freiwirtschaft. My Swiss German is fairly poor despite my heritage, but this philosophy really centers among three terms that start with the letter F. Free Geld, which is free money. All money is issued by a limited period of constant value, so there's no inflation or deflation, just money supply will just perfectly match whatever the circulation is needed. And long-term savings, if you want to get a real return, requires investments in bonds or stocks. Nobody should be able to get a positive real return by just holding their money in the bank. The second one is free land, which is all land should be commonly owned, and or else public institutions should be the only one who can rent property. Like there should not be private landlords. It's kind of similar to George's, however, except it's it's more anti-private property version of George's. And the last one is Freihandel, or free trade, where there should be unrestrained free trade, and there should be effectively a global single currency to replace the gold standard, which was the dominant way of trade back when those concepts came. The main thing that they contribute to economics is their criticism of the monetary system and their idea that prices do not accurately convey information. In classical economics, the price is a signal to show how scarce something is relative to something else. Whereas Fractional economics believe that prices really have no signaling impact, and it could just be just a derivative of random information flows. And if you do see prices move, it's a product of a destabilizing currency. The next thing I'm going to talk about is the gift economy. The gift economy is the idea of an economic system where valuables are not sold or purchased. And the way that people do things and get things done or exchange items really is they have to be all through voluntary gift giving. There could be an expectation of reciprocity, like if I gave my friend like a copy of my book, he could give me a ham sandwich or whatever, but not like in a purely like business sense, like a barter economy where it's like a straight trade. It's like if you know somebody needs something that you produce, you give it to them, and when they know that they need the thing that you produce, they'll just give it to you. And everybody just works on just maximizing their product of whatever their skills and value they provide to the world. And then people will just give them stuff that they need and cannot do themselves. It's kind of like a global Patreon system where instead of Patreon is used for YouTubers and other content creators, you use Patreon to sponsor your butcher, your baker, your candlestick maker, your car manufacturers, your landlord, etc. And then in return, they will be a patron to you in that way. And instead of money, you just exchange whatever the product or service you offer to the people. I just think that this is overly idealistic and would never work in the real world. Okay, so next we're going to be talking about socioeconomics, and it's about how social trends impact economic activity. And it's kind of the reverse of my theory on this very subject, which I'm going to talk about in part 9, where it's saying that social norms and social values are what dictate economic decisions, and changes in those are what dictate the changes in the economy. So let's just say, for an example, in their model would be that, say it becomes more socially acceptable for two non-related families to share the same house. So like you have two sets of parents and two sets of kids living in a 6-bedroom house instead of each of them having a 3-bedroom house. Or maybe just to be more economically efficient, maybe they would say share a 5-bedroom house instead. And so if that just becomes more trendy, then as a result, there'll be less demand for smaller houses and more demand for bigger houses, or just less demand for houses in general, because more people decide to live in this alternative lifestyle of like a friend family hybrid thing. And so they think it's the social trend that moves the economy, whereas I think it would be, if anything, that that social trend would arise from housing becoming unaffordable and people having less direct family ties due to other economic variables, and it's the economic variable that pushes the social one. Socioeconomics, they generally believe the reverse. Happiness economics is the idea that quality of life and emotional well-being of the citizenry should be what is the definition of success for an economy, rather than absolute output or tangible standard of living. An example of a country that has really embraced this idea is Bhutan. And the government of Bhutan, which is the small country in the Himalayas between India and China, for those who are not familiar with it, is that instead of GDP and GNP, they use GDH, and to stand for gross domestic happiness and gross national happiness. And they just believe that the traditional way of managing an economy and measuring economy rewards selfish behavior and degradation of the environment and increasing the gap between rich and poor and other things that make people unhappy. And so there are arguments, you can have a much lower income and a much simpler standard of living, but due to reprioritizing that spending on experiences or taking care of others, your society will be a much happier one than one that is more wealthy. I think that designing an economic framework around the idea of happiness is a bad idea, because even in mainstream psychology, happiness is a fleeting feeling, and the goal of life isn't really to maximize happiness, but to maximize meaning and fulfillment. But even if you exclude just from the psychological element of this, measuring happiness, which is an ever-moving target that has hedonic adjustments back down to base emotional levels, is not really an effective way to manage policy. And how do you measure? Like, what's the scale of happiness on a 1 to 10? There's no units of happiness that are standardized in every culture and be quantified. So it's difficult to measure and report this accurately, even if we think it is a just goal. The next one I'm going to talk about are the Chicago Boys. For those who are not familiar, the Chicago Boys were a group of economists that subscribed to the Chicago School of Economics, who went down to Chile to reform their economy during the dictatorship of Pinochet. Yeah, they were originally from Latin America. They studied at the University of Chicago, and some of them also went to Harvard and MIT. And they adopted the Freshwater School of Economics, Chicago School, about advocating widespread deregulation and privatization of the economy, a more freer market economy. And when they came back from their studies, they moved back to Chile and just gave this framework to Pinochet, who applied it and made Chile one of the most free market countries in the world. And in terms of living standards and GDP per capita, it is the highest in Latin America, and the only Latin American country to have a complete visa waiver with the United States. Chile also, because of the efforts of the Chicago Boys, has some of the lowest government debt the GDP in the world and has the most solvent social security system in the world as well. The Chilean miracle, which was kind of a result of the success of the Chicago Boys, has been seen as a model for economic development in other emerging market countries. But it really, due to political restraints and other non-economic factors, it has been hard to employ this in more democratic governments where the fat that the Chicago Boys cut in the Chilean economy is a livelihood and a voting bloc that is very hard to destroy. The last one we're going to talk about is distribution. And distributionism is an economic theory that I call like a third way concept. It is based on Catholic social teaching. For those who are not Roman Catholic, is the idea that based on the doctrine of human dignity and common good in the Catholic Church, that there are certain responsibilities that the individual and the state have in terms of social justice and social organization and wealth redistribution. The Catholic Church, like any other community of its size or even a fraction of its size, is very ideologically diverse. So how to apply Catholic social teaching is something that has been debated since at least the late 19th century. And one of the ideas that came out about this is distributionism, which is the idea that you should not have too many assets held by too few people. That's, if I had to summarize it, that assets need to be widely owned rather than concentrated. Distributionism is both anti-laissez-faire capitalism and anti-socialism, and for opposite reasons. In socialism, the state owns all of the means of production, and that has the concentration in one hand, and that's usually a secular government, and the government may not have the best interests of the people and may not factor in that in their own decision making. And also, it's just due to the flaws of human nature, it is dangerous to trust such few decision makers to decide who gets what in an economy. They oppose capitalism for the reason that they believe that laissez-faire capitalism is exploitative and flawed, because in a laissez-faire economy, they expect that the assets and private property will be heavily concentrated among a small elite. And that small elite may not have the best interests of the people and may act in just as an abusive way for their own self-interest, like a government would in a socialist system. So what's the solution here? If you don't like the concentration of wealth and power among capitalist business owners and social elites, and you don't like the concentration of power in the form of the state and government officials, the answer really in a distributionist economy would be just to do whatever it takes to keep private property and the means of production divided into as many hands as possible. So the distributionists are really strong advocates of small business, guilds, member-owned mutual organizations, and very, very strict antitrust laws. Like they'd be very anti-multinational corporation in the modern sense. They want every industry to be produced by a countless amount of small business owners who will compete against each other to make sure it's doing what is in the right interest of the people, because they have to in order to survive, because there's so much competition out there. They really want is free competition to the extreme. And in theory, this sounds really great, actually. The main concern that maybe I would have with this, and I'm not too big of an expert on distributionist economics, is every business capable of being run as either a mutual or being a collective of small businesses? Can every industry work that way? Like, how do you do things of scale if it's all run by small businesses? Whether that's maybe mass production of automobiles or building giant infrastructure projects or a variety of things that would require mass scale. But the theory is that you just may create mutuals, kind of like a lot of insurance companies, with Northwestern Mutual being the most famous in America, who do this, credit unions for banks, and maybe even for like real estate and other major projects, maybe splitting them up in like a REIT-like structure where it's owned across the community and there's no like real dom, and you have a cap. Like if there's a stock market in this system, you'd probably have to have a cap of like no individual owning more than, say, I don't know, 0.5% of a company and work that way. I don't really think that has really been tried anywhere. The only people who adopt it are very fringe political parties around the Western world. The most famous advocate of this is G.K. Chesterton. And I guess again, it really hasn't been applied. I mean, it's neither right wing or left wing, but kind of like Georgism, it's like an interesting concept that maybe should be tried on a small scale to see how well it works. That is level 8, which is heterodox economics. Hello and welcome to Analyzing Finance with Nick. This is the final iceberg of economics. And in levels 1 through 7, we covered the Reddit meme of Iceberg of Economics and used his terms or her terms to kind of slowly move down to the crazy talk. Level 8 was the schools of heterodox economics that were not included in the iceberg, that I thought were noteworthy enough to have their own tier. And now we're in the bottom tier, which is my theories on economics, and more specifically, my theories of economics that differ from the rest of the topics on the iceberg. Some of them are connected to some of the ideas here, others are just kind of completely out of left field. But as somebody who considers himself to be a self-taught macroeconomist, I did get my undergraduate degree in economics, but I didn't really do anything in graduate or PhD level in the field. But I still have a lot of ideas about this just through years of reading and studying it, and also being a professional market participant in the financial sector. And without further ado, let's get going. The first one I call is prosperity theory of democratic politics. And democratic, I mean just in the sense of democracy more than the United States Democratic Party. But it's the idea as like a city passes originally policies that promote economic development and growth in the beginning when it's relatively small. And as the city gets more successful, it brings a bunch of economic prosperity. But with that economic prosperity, it also brings people who are more likely to vote for redistributionist policies, whether it's lower income people moving to those cities because since they have more wealth, they have more charity and other things to take care of the poor, or it's younger, more idealistic people who come there and both see like the unfairness in the world and want to solve that through redistribution, or it attracts academics or other left-leaning minded people come to these cities after their initial gains of prosperity. And because of those change of demographics, as the city grows, the city changes its voting patterns to be more anti-free market, more redistributionist, and more lenient on crime. And as a result of that, they unintentionally kill the golden goose that drove the success of that city. And because of that, then you see people moving out, and it's often the first people to move out, ironically, happen to be the same people who moved, or maybe not the same exact people, because this happens over decades and periods, but the same demographic that would have moved to the city when it was growing. It's younger people looking for economic opportunities, students, academics, the people who cannot financially support themselves in the city because the quality of life has gone down. And so they leave and to this next city that's booming. And as a result, the politics again then starts to shift more back to a more conservative, tough on crime, more pro-economic development policy, because the people who stay there want to see their city turn around and those who were there just really for more fleeting benefits have left. And we can see this just for examples of like the political trends of pretty much every major city in the United States of America. As cities cities that used to be very politically conservative, especially for sizes of its population density, such as San Diego, Los Angeles, Orange County, Atlanta, Georgia, Dallas, Phoenix, Arizona. As they've grown bigger, their politics has shifted to the left, as the prosperity has attracted people who would more be in favor of redistribution as policies without realizing it's those same political philosophies that prevent the city from being competitive and take away a lot of its golden goose. Like an example with Los Angeles, a lot of businesses in outside the entertainment industry have largely left the city and moved their corporate headquarters to places in such as Dallas, Texas. And then on the other side, when a city starts to struggle, they do the reverse. They pass a lot of economic development incentives to encourage businesses to move there, and they try to clean up on crime. Like example would be like when New York had its trough in the 80s and 90s. The New Yorkers elected more tough on crime leadership, and they also elected leadership that promoted more growth of local businesses and having big companies move to New York City. That just became example also would be say like upstate New York and Detroit and Michigan as a whole, whose politics is to be the most progressive in America. It was what we consider a place like California in its politics 60 years ago, and now is more purplish because they have to make changes because what they were doing was killing their golden goose. But with Detroit, it wasn't just due to politics. There was just bigger structural issues there. But Michigan, as a result, is an example of how somebody on the other side of the curve, where a state whose politics have shifted because of the front end of the prosperity theory of democratic politics is currently what's going on in Georgia. Georgia used to be a very conservative state. The conservative politicians passed a lot of pro-business legislation and tax incentives and other things to attract businesses to move to Atlanta. Atlanta becomes a much more prosperous city. It brings in a new, younger, more progressive crowd. And as a result, the city's politics shift, the state's politics, and Georgia is now rapidly trending towards becoming a blue state. And so the sad thing as an American seeing this is that it seems like the only way that people will vote for policies that promote development and cleaning up a city is things have to go get bad enough first to demand change. And whenever things get good, they can't stay good because people will vote for policies that think, oh, the city's doing well, it can afford to take on all these extra burdens, and they will just, humanity will inevitably vote to kill its golden gooses in its most prosperous cities, and will only really do things by the time it's turned the corner and it's too late. This is kind of a half-baked theory, but I want to know what you guys think about the prosperity theory of democratic politics. Next one is compensation theory, which is, I did a whole video on this, which I'll link to in the description, but it's the idea that real incomes since the year 2000 have been not catching up with the cost of living and have been structurally falling. And as a result, governments and banks have been compensating people for their lack of income and replaced their spending power from actual earnings growth and productivity growth with cheaper access to credit in the forms of cheaper mortgages pre-2008, more generous access to student loans, credit cards, or just in the post-pandemic outright stimulus checks, because the consumer is not making enough money to keep up with the demand for growth of consumption that businesses need to maintain their earnings growth, or for tax revenues to grow proportionally to fund the government. And yeah, if you want to know more of that, watch my video on compensation theory. The next one is social support systems and domestic work not being quantified skews GDP to the upside. If you look at back to like say 50 or 100 years ago, you had a lot closer knit extended families and local communities that would help each other out really without compensation. Like The example of this is, say if you live near your family members, instead of having to get an Uber to go to the airport, you could have your family member take you to the airport. And even though you're probably better off just in terms of both socially by spending more time with your family members and financially by saving the money and not buying the Uber or having your family member take you to the airport, that'll actually show as a result of lower GDP because you're not spending that money. And it's not just having your family members take you to the airport. It could be like having a stay-at-home wife do childcare versus paying $2,000 a month to a daycare center to do that, or going out to eat versus cooking simply just because you don't have time, or if you live alone and it just doesn't make sense to cook. Yeah, going out to eat adds more to GDP. Sending your kids to the daycare center adds to the GDP because there's more money being spent in the economy. But has living standards really gone up? Like, no, I would argue. In fact, your life's worse because you have to outsource all the stuff that used to be done through your family networks and your communities and have to pay outside professionals to do it. You're worse off, both in terms of your weakened social ties and also financially, because you have to spend a bunch of money that previous generations did not have to spend on getting the same services. The tricky thing is I don't know how much lower GDP should be to factor the fact that people now have to pay for things that they used to not have to pay for. And that's where a source of economic growth is. But is that really economic growth, or is that just people having to pay for something that they didn't previously and therefore their life is actually worse? I'm surprised this really isn't talked about that much. And I think this is really the strongest economic argument for social conservatives. And even though that is the case, the fact that they fail to use it kind of baffles me. The next one is the automation ladder pull, which is the idea that automation really has a big disruption on the growth model for emerging market countries. The classical way that emerging market countries, or really any country really develops itself, it first starts as developing basic agriculture-based civilization. And then once you do that, you go up to the next level, which is very light manufacturing. Then you do more advanced manufacturing, and as the education of your population and the amount of foreign direct investment and capital builds in your country, then you can move up to heavy manufacturing, and then eventually to a service economy, and then a digital service economy, and you just keep moving up into modernity. However, with things such as AI and robotics and the geopolitical trend to onshore, the ramp that countries such as Japan and Taiwan and South Korea have been able to use in Israel to move up the ladder may not be able to happen for other countries. The thing is, I've noticed with the classic industrial model, the earlier a country pursued this, the more successful it worked for them. And basically after a certain point, like if your country started really truly entering the industrialization process after, say, 1975, it's not been as work. A lot of those countries who started their industrialization within the last 50 years have gotten stuck in the middle income trap, at least just Brazil and China and South Africa could fit into that former Soviet Union could fit into that category. And they get stuck because their population ages from lowering birth rates faster than they can develop. But even on top of that, I think what's going to be an accelerant of this is that if you have automation technology and robots, which means you're going to be building your more heavier manufacturing at home, especially because energy costs are cheaper and shipping costs are cheaper if you keep it closer to home, whether that's in North America or Europe, than importing from Asia or Africa or South America. Those countries will not have the chance to climb up and the value chain by moving up the lower stages. Like, it's very difficult to go from like a subsistence agriculture economy to a digital services college educated economy in one fast swoop. There are some things you can advance quicker. Like, for example, in Africa, they never really built telephone poles. They went straight from having no phones to cell phone networks. But That's more of a product of technological innovation and not requiring generations of education and cultural adaptation to fit into the global economy. And then a lot of middle income countries, such as China and Southeast Asia predominantly, who want to move out of the manufacturing into the service economy, are going to have a harder time with that because a lot of the services jobs that they were counting on being available are going to be automated away by AI. And so a lot of these countries that supposedly have a demographic boom for having a lot of young and educated people that may turn into a demographic disaster is now you have a bunch of angry, overeducated people who are underemployed, which is the roots of political instability and revolution. So, yeah, how is the advancement in technology going to affect the classical ascent of countries into the global international order and living standard? By using is automation effectively a ladder pull that prevents poor countries from having a path to ascension. And these poor countries feel like they have no way to peacefully increase their standard of living through participating in the global economy. Will they try to resort to other means to try to assert themselves in the world? It's a lot of food for thought. Longevity economics is kind of a term that I kind of just came up with, but it's just that I've been reading a lot about human life and longevity, and I really wanted to grow GDP in the fastest way possible. The key really would be to extend human life. Based on the research I've done on longevity, if you averaged the global death age, life expectancy by 1 year older, so like everybody lived 1 year longer, then that would increase GDP by $16 trillion. By comparison, global GDP right now is $105 trillion. So that would increase GDP by 15% overnight if we increased the average life expectancy for the whole world by just 1 year. Right now, the global life expectancy in the world as of 2023 is 73.16 years. If you go back to 2000, it was 66 years. I think that just 7 years in gains has probably been a big driver for GDP growth for multiple reasons. One, people live longer, they're going to be consuming longer. If people live longer, those who have enough savings to invest are going to have more compounded returns because over their lifetime before they have to pass it down to the next generation and pay estate tax because simply they're alive longer. And there's a lot of other beneficial consequences to this. So if you really are somebody whose goal as an economist or a policymaker is to maximize living standards and grow the economy as fast as possible, then really we should have more investment in longevity science and helping people live longer, because living longer is, again, the fastest way to grow GDP. It effectively increases the productivity of the society by a much longer time frame. The next concept I'm going to be talking about in this iceberg is the idea that socioeconomics is backwards. Socioeconomics is the idea that social mores and values determine economic decisions, where my theory on this is that economic incentives determine social and moral values and social mores. Like, the most politically correct example I can give on this, because this is very controversial, a lot of the examples I would have, would be the idea that for younger people, living at home has become destigmatized. It's way more common, say, for somebody under 35 now, but out of college, or maybe they didn't go to college, but like done with their schooling, to still live with their parents. And this has been common in places like Italy and Greece for much longer, but this started to become mainstream in America post the Great Financial Crisis in 2008. And this might be aging me, but whenever I was in high school or college, there was a real stigma against people living with their parents past the age of 22 in the United States. You're supposed to be on your own back then, no exceptions. Some people were strict enough to kick their kids out at 18. However, I think the reason why that stigma was there is because it was relatively affordable to live on your own back then compared to today. Like, if you adjust the cost of renting an apartment and having a car and all the basic needs of living independently in a major metropolitan area relative to wages pre 2008, it was a lot more affordable than it was post 2008. And as a result of this, the fact that a lot of people who were really otherwise intended to be independent and had that goal couldn't, just because of economic constraints and the fact that real wages dropped relative to cost of living, particularly in the cities that were driving most of the jobs, made it so that it just no longer was financially viable for a lot of younger people to live independent. So they had to live with their parents by default. And because this economic incentive became a much bigger dilemma and way more common among people who would not be stigmatized as losers historically, the society eased off and became a little bit more tolerant of such an arrangement, where in 2000 it was utterly unacceptable for somebody like 26 to 30 years old to live with their parents, whereas now nobody even bats an eye on it. It wasn't because all of a sudden parents became a lot more empathetic in the last 20 years. No, it's because it became financially unviable to hold that standard. And so as a result, the standard was dropped. And you can look at the cost of one type or down itself, but whether it goes up or down relative to alternatives, and that will determine how the morals change. And so, yeah, economics drives social change more than social change driving economics. And so as a result, if you are somebody who really cares about social issues in politics and culture and you want to change them, instead of trying to bang people on the head and say, like, you need to adopt my values and vote my way because of X, Y, and Z, instead you need to pass economic policies that incentivize people living what you determine to be a more morally optimal lifestyle. Because if the financial incentives line up with the social policy goal that you want, you are more likely to have people adopt that lifestyle because it becomes relatively more economically advantageous to do so than it would without that policy, or on the opposite side, a policy that runs counter to that. Like, lots of reasons I think, again, social conservatives have a problem. So their lifestyle has become less affordable relative to a more socially permissive lifestyle over the last 30 years. And that might explain a lot of the social trends in the Western world. I mean, that actually probably goes back 60 years, sorry. But that is my theory on inverse socioeconomics. The next one I'm going to talk about is lying flat and the Atlas Shrugged moment for China. Like, I talked about this with Chris Street in an interview I did recently, but I think the idea is that I label this just as tongue-in-cheek, the incels destroying the Chinese economy. And that's just because they have a lot of young men who can't afford either the dowry or to buy a house or whatever social status symbol they need to impress a potential spouse. And they will never be able to based on their income and career trajectory. And these are people with college educations. It's not just your typical factory worker. And so they decide to opt out and just make a bare enough to support a bare living through Upwork and other gig economy stuff, and then just chill out and play video games the rest of the time. And it's called lying flat. It's most common in Asia, but they have other movements like NEETs and anti-work, which I've talked about on this channel before. And a lot of this is a byproduct simply just because the marginal difference in your income between the cost of just surviving versus the cost of thriving is wider than ever due to social safety nets and a variety of other things going on in the economy. It's fairly easy to just get by, or at least relatively to the past. But due to things such as how housing prices have been distorted in many countries in the world, and how the top of the career hierarchies has gotten a lot more competitive, it's a lot harder to get to the level which is considered like a traditional upper middle class lifestyle. That has gotten a lot more expensive relative to the gains in incomes in that demographic or that prospective demographic compared to, whereas just getting by has not gotten any more difficult. It's probably actually gotten easier. So as a result, since the gap between surviving and thriving is wider and feels more unattainable, less people around the world are deciding to pursue it. And we really risk just a collective Atlas shrugged moment, but not necessarily because these are anti-government people who just don't like taxes. It's just they feel like the juice isn't worth the squeeze. And it's the most at risk in China, and that's why we're seeing the issues with high youth unemployment despite having a growing economy. I think this is a cause of that. But it's not just China. This can happen elsewhere too. The next one is I call complexity as a cope. It's the idea that a lot of economists will make increasingly complex economic theories to try to factor in why their policy goals are good for the economy, like all those various, as you seen earlier in the iceberg, there's like 5 or 6 different supposed schools of economics that really just are all environmentalist economics or trying to fit the environmentalist goal into the framework of neoclassical or Keynesian economics because you just think that's a more admirable goal than actual economic growth. But that's, so I call it complexity as a cope because the more complex variables you have, you're coping for the fact you want to really just add something that you find personally important, whether it's a moral value or a certain ideological cause or whatever, to shove that in, and you'll add as much variables and complexity to economic theory to make that make sense. Next is mental health and economics. I think that this, especially as mental health issues continue to become more prominent, I don't think mental health is being correctly factored into the economy. Like the spending on mental health probably actually boosts GDP, even though it's a symptom of a society that is getting less healthy and quality of life is going down. So, yeah, I mean, if your GDP grows 5% because people are spending 20% more on antidepressants and therapists, and this is an extreme example, but you get my point. It's not, it's similar to what I talked about with the social support systems. A lot of this mental health is a byproduct, again, of having the lack of social support systems. So instead of being able to talk to some close members of your community or your family members or your friends, you now have to pay a therapist to listen to you because there's nobody in your life who actually cares enough to pay attention to you. I'm not saying there's not severe mental health issues that require therapists. There definitely are. But I think the answer is like that I hear blatantly a lot. It's like when somebody has a personal problem, instead of being willing to listen, you just tell them nonchalantly, go to therapy. That's not a solution. That's just a sign of, like, again, the disintegration of the community, which is not really being factored into the decline of the economy, like to the growth, economic growth. There should be a negative externality that's not being priced in. And yeah, if you have, like, say maybe you have more productivity by working people longer hours for less pay, but if that causes everybody to be mentally unhealthy and unstable, and as a result they have to spend more on medication or therapy, or worse, you see more, like, I don't know, crime or other negative consequences for a less mentally healthy society or lower life expectancy or whatever because of it. Is that really a proper trade-off? Again, this is really a difficult thing to quantify because this is a more subjective issue. But I think that it is something that really, I think that the economics profession and research has not really dived into. They've gone to behavioral economics. Now, behavioral tics will cause the rational man theory to deteriorate a little bit, which I talked about in the iceberg. But mental health and economics, I think, is another one that's not really being properly discussed. So the last one we're actually going to talk about is the Duesenberry Effect actually being the most important concept of economics. Now, for those who are not familiar with the Duesenberry Effect, which I'll probably do a whole video on it, is the idea that people have in general of a hard time ratcheting down living standards. People get accustomed to a certain quality of life, and if due to external circumstances or personal bad decisions, they are no longer able to maintain that living standard. Even if their income can no longer support it, people will continue to spend like they had that previous level of income because the thought of having to cut your quality of life is so bad, especially if it's a more permanent realignment and not just something that's like a temporary setback. Like say you lose a job temporarily, but you can get one that paid just as much or better in a couple months. That's not Duesenberry Effect. That's just minding a gap. Or say like use the Duesenberry Effect to decline, be like, say like you work in an industry that becomes obsolete rapidly overnight. You can't find a job that pays half of what you used to. And that's so you may have to take something that takes 40 or 30% of your old salary, and that's your new normal. Yeah, and yet you keep spending like you did in your old life. That's the example of the Duesenberry Effect. People will do anything to keep their old standard of living. I just know several examples of this. And this is why you have to be careful with lifestyle inflation, which you have to be very slow as you build up your career to increase the amount of spending and the lifestyle qualities you pay for, because if there is a chance you have a setback, it's going to be very hard for you to adjust back down. That's why credit card debt is such a common problem, because people have circumstances that they have a disruption in their earning power for some various reason or another, and they fail to adjust, so they keep spending like they used to, and even though they know they should cut back, they can't because they've been accustomed to such a lifestyle. And this is not just really purely spending decisions. This also can apply to geography. Like say if you're from a town that you didn't like, that's just a poor quality life, and you move to a much nicer city, but that nicer city is more expensive, and you no longer can afford to live in the nicer city because of your financial circumstances have changed or it's gotten more expensive. The option could be just to move back to your hometown. But people will not do that because they're used to the better quality of life in the town they moved to. That like the idea of moving back home is just unacceptable. This could also happen with dating and romantic partners, where when you don't have that much dating experience, you're okay with dating somebody who may not be as high quality because you haven't really experienced a higher quality romantic partner. But once you do get to a certain threshold and you have a great experience with that, and it doesn't work out for some reason, and you're like, you can't date people who you would perceive to be not at the same level as your ex. And that is romantic Duesenberry Effect. Is that dating gets harder as people have had more relationships, not because there's less options. In fact, oftentimes there's more options. The problem is that they're accustomed to such a quality and they cannot adjust their standards down. And and then the most dangerous part of this is actually on the country level, where a country as a whole is used to a certain standard of living, but then because of geopolitical shifts or other economic shifts, the workers in that country are no longer competitive and they have to adjust down to a standard of living, but politicians will never tell them that because that's how they lose elections. And so that's how you get populism and other negative political consequences, because people feel like they're entitled to a certain living standard, even as economic conditions have changed, that your nation as a whole is not competitive. I mean, look at what happened to Germany after World War I is like the most extreme and worst example of how that can happen. A country that's accustomed to being a dominant world power and being a leader in living standard and quality of life and a variety of other things. And then after the First World War, their whole economy and society got hollowed out and they didn't take it very well. And you could see like the political volatility in the US as inflation started to rise in the 60s and the 70s. And you see the rise of political populism now, since basically 2015, when after 16 years of real wages falling. And so this whole idea of people not being able to adjust to Duesenberry effect creates a lot of the inefficiencies in the global economy and a lot of the inconsistencies that people kind of subconsciously feel but can't really objectively quantify. That concludes the iceberg of finance. Let me know what you think and which one of these alternative theories that I have you think is the most legitimate and or the most interesting. I'd love to hear you guys discuss in the comments, and if I should make specific videos about any of these concepts other than compensation theory, which I've already done. Thanks for watching.